Good morning, everyone. Good afternoon, everyone, depending on where you are in Canada. Welcome to Raintree Financial Services Virtual Investor Conference of 2023. We are so glad to have you here joining us today. We hope you find the information shared here valuable in your investment journey. My name is Jay Butani. I'm the president of Raintree Wealth Management, where we specialize in providing discretionary portfolio management for our clients. I joined the Raintree family in April of last year and could not be more excited to be part of the Raintree team. And I'm honored today to be hosting the conference for you. A little bit about me. I had spent nearly 30 years in the industry before joining Raintree Wealth Management. I started off my career as a private financial planner and advisor, moving to the asset management business in 2000. I spent 20 years in the asset management space, working for a firm like Altamira Investments, where I was head of corporate strategy. I moved over to AGF Investments, the largest independent asset manager in Canada, managing over 50 billion assets, where I held various roles, including global head of product and head of global ETF strategy. Enough about me. At today's conference, you'll be hearing from some of the top experts in the investment space, all focused on helping you maximize returns on private and alternative investments. Our speakers come from various backgrounds and regions, so you'll get a well-rounded insight into different strategies and opportunities available to you. You'll hear from Peter Kincaid, CEO of Raintree Capital, who will kick off our conference today and who I'll introduce shortly. Our keynote speaker is Larry Berman. Larry is the co-founder of ETF Capital Management and Quintessence Wealth. Larry is well known as the host of Berman's Call on BNN Bloomberg. Our agenda today is broken up into three main parts. The first session will be approximately just under 2 hours, where we'll have several speakers and some time for questions. We'll have a short intermission of around 12:15 Mountain Time, 2:15 Eastern Time for about 10 minutes. From there on, we'll have a series of presentations and rapid fire going until about 1:25 Mountain or 3:25 Eastern. At that point, our keynote speaker, Larry, will spend some time discussing global markets and his views. For all of our speakers, our online chat will be open for questions and comments. I will moderate the discussion forum and ask any questions that may come through. Unfortunately, due to time constraints in the second half of our session, we may not be able to get to your questions. As a result, we ask that you follow up with your Raintree Wealth advisor or follow up with us after the fact. We know investors today face several unique challenges. Increasing volatility in markets, new competitive forces, and economic uncertainty are some of the things that are happening. Our goal here is to equip you with the knowledge to help you navigate these headwinds while continuing to grow your wealth. At this conference, we'll explore alternative asset classes, tax efficiency strategies, portfolio diversification principles, and risk management techniques. Whether you're a seasoned investor or just starting your path towards financial freedom, this virtual conference will help provide invaluable advice to managing your private and alternative investments. With that, are we ready to kick off the conference? Yeah. So our first speaker is Peter Kincaid. Peter is the CEO of Raintree Capital. Peter is responsible for the direction and oversight of the company and its many divisions. He brings a tremendous amount of attention and detail, focus, and business expertise and experience to the role while maintaining the core values built within Raintree Capital. I am delighted here today to introduce Peter Kincaid, my CEO and friend. Over to you, Peter.
Thanks, Jay. And for a guy who just got back from the Super Bowl, you're looking pretty good today. So
thank you.
I am excited to address everyone today. I'm going to share my screen here, so just bear with me a moment and we will get started. All right, so welcome everyone. Thanks for attending today's conference, to all our private wealth advisors and to all of our clients and maybe even potential clients. I'd like to thank you for taking the time to join us today. I'm going to spend my presentation in two parts. First, just giving you a little bit more background on Raintree and all of our corporate entities. And then I'm going to dive into 5 new themes for the new world. And why I say new themes is I did provide 5 themes at our last virtual conference. I'm going to touch on those a little bit. And these are really themes that I see driving investment making decision moving forward, whether that's through our organization or to impart some ideas for investors in terms of how they think about their own portfolios. That's really what I hope to inspire today. So just quickly about Raintree. The Raintree group of companies, we were founded in 2010 and really initially focused on private and alternative investments. Over the last decade or so, we've really changed our business to be much more focused around various investment financial services and different types of investment products and even insurance products. And so we've really tried to round out the types of financial services that we offer to our clients through our advisors across the country. We've helped place just about $2 billion of capital over the last decade or so, and we're dedicated to providing access to opportunity. What I mean by that is that we are constantly hunting down the very best investment products and services that we can offer to our clients through our great advisors across the country. So I'm going to tackle each business unit and service in a little bit more description. Let's start with Raintree Financial Solutions. Raintree Financial Solutions is what we describe as a private capital dealer. There we focus on offering alternative or private investments. If you're new to the concept, private investments and alternative investments, what that really means is these are investments that are not traded on public stock exchanges, and they require some additional skill and expertise in terms of evaluating and exploring these types of investments. We're going to have a number of managers on today that manage various investments and investment types that we would broadly categorize as alternative or private investments. We also offer the services of portfolio managers to round out and form a client's overall portfolio. And we think that portfolio managers providing discretionary investment and management, meaning that they take control of the portfolio decisions that you're making on the traditional side of your portfolio, should really form the core of one's portfolio. And then we help investors explore alternative investments to round out or supplement their portfolio. And the reality is that we've framed that or we've taken that and we've created our investment philosophy, which we aptly titled Core Plus Explore. And so that really drives the way that we advise clients in terms of our recommendations and fitting the right types of products and services into their investment portfolio. We have 45 private wealth advisors from Ontario out to Western Canada. And that's an area of our business that we continue to grow through building high performance teams. Raintree Wealth Management, as Jay mentioned, is our discretionary portfolio manager and investment fund manager. What that means is that we provide discretionary investment management advice to our clients. We're one of the options that our private wealth advisors can use from an implementation perspective. A little bit more about Raintree Wealth Management. We have a more value-oriented approach, and when you see my themes, a number of them are going to be more value biased than growth biased. I'll hint at that right now. But I think that's an important facet of how our outlook works for our clients and what draws, I think, our clients to us. We also believe that asset allocation drives returns. And so a big part of the work that we do as investment managers is setting asset allocation. That's the broad or global allocation of a client's portfolio, starting between the mix of equities and fixed income, but also having a more regional focus in terms of the markets that we're providing access to. We set that as an investment committee, and we also then find who we think are the very best investment managers to manage certain subcomponents of our portfolio. And Larry Berman and ETF Capital Management is a good example of that. He manages our tactical component of the portfolios, and excited to have him on today. Raintree Corporate Finance is an advisory services firm. So here we're actually helping managers and business owners access the capital markets. We advise them on the best structures to do so, how to approach the capital markets. And we also complete due diligence activities through this business unit. We also advise our alternative managers in terms of their structure and their approach to the capital markets. And then finally, a big piece of what we do is providing M&A or mergers and acquisitions advice to business owners and managers who are either looking to acquire other businesses or they themselves look to sell their business. And we will run that process for them, handle the negotiations, and handle the different components that compose that. For business owners, a big piece of how this fits into our overall Raintree service mix is that with our private wealth advisors, if they're talking to you and working on your retirement planning, oftentimes business owners, big piece of their retirement plan is actually exiting their business. And so we can supply that service as a part of your overall retirement planning strategy. And then finally, Raintree Insurance Services. This is one of the fastest growing areas of our business. Here we offer life insurance products, a critical component to many clients' financial plans from a risk management perspective, or even a tax planning and estate planning perspective. So this is a bigger piece of our business today, and an important part of the financial planning exercise that many of our clients go through. Finally, I just want to reiterate, we've got many great advisors across not only the country, but also across the platforms. So some of our advisors focus on insurance offerings, some focus on the discretionary wealth management side. So we have independent advisors on that side of our platform. And then of course, the private wealth advisors. And I also want to thank and welcome our head office team, both here in Edmonton and our satellite and virtual office in the GTA. So 5 new themes that I'm going to cover today. I'm going to get into each one of them, but I wanted to go back and just talk very briefly about some of the themes I brought up in about 15 months ago, last time we hosted a conference like this. Then I had my 5 themes were COVID-19. The symptoms then were still inconclusive, and that meant more on the economy. Government interference and what impact that may have on investments moving forward. Inflation, which, spoiler alert, continues to be one of my 5 themes. Taxes coming, the view at that time, and I still think is reasonable, is at some point we're going to have to pay for the amount of government interference that's been injected into the markets. And then TINA, which is an acronym for there is no alternative. And I tried to dispel that myth that part of what was driving the public markets and quite frankly, fixed income returns, was this theme of TINA, or there being no alternative, and really the boon around alternative and private investments was a big and growing theme, and continues to be a theme. At that time, we were really trying to implore investors to think about alternative investments as part of their portfolio, in large part to mitigate some of what we actually ended up seeing in 2022, which was an extremely difficult market, both on the equity side and the fixed income side of people's portfolios. And so obviously, we continue to think that moving forward, it is a deserving part of a client's portfolio and something to think about. But I just want to reiterate that the themes should really just frame how you might look at, evaluate, and make investments. None of this is specific investment advice, but I think these are some of the driving forces moving forward. And I should also say that many of these themes are longer term themes. I'm not talking about what might move the market tomorrow. I'm talking about what might move the market here over the next year, 3 years, 5 years, and even beyond that. and positioning one's portfolio to start to benefit from some of those key themes. So the first theme that I'll talk about is inflation. Inflation is obviously on everybody's minds. It seems to be in every headline that we read today. The good news is we've started to see some of that peak inflation come off, and the trajectory of inflation does seem to be on a downward trend. So I think that's a very positive movement. A big piece of that, I think, is commodity prices, which have come off significantly from their peak, driven largely by sort of COVID-related activities, either because of the way that people were consuming commodities and goods, and also the supply shortages that were created out of COVID. So, we're seeing a big piece of that inflation pie start to come off quite a bit. And the other thing that I wanted to point out here around commodities is how much of commodity prices are really driven by energy. All of these factors here, up to the purplish bar, are energy related components of the commodity mix. And you can see that they're peaking out very close to where they peaked out up to 2014 when we started to see that last energy downturn. So, this continues to be an area that I think needs to be watched very closely from an investment management perspective. What we're now seeing is a divergence where goods are starting to come way down, both in terms of cost, but also expectations around cost. And inflation is often driven by expectation, even though we measure it by sort of the history or by measuring it by what's happened. And what you can see now is a divergence between expectations around, and I should say this is American data, expectations around manufacturing orders coming in versus service-related costs. And I think this next chart visualizes it even better. You can see now what's driving a growing component of the inflation data is actually services, whereas energy has come off, and goods-related inflation has come off quite a bit. Food continues to be a bit persistent, but I think that the services component is now what's going to drive the main focus around inflation moving forward. And result of that is unemployment, and a lot of the focus around unemployment numbers that have come in. Both Canada and the US surprised last month in terms of new jobs data. Canada is at record lows in terms of unemployment. And quite frankly, the US is also in the same boat where if you look at just the amount of jobs that they've created since COVID, really began, it tremendously outpaces job creation leading up to COVID. So just a tremendous amount of pressure inside of the economy related to job and job creation, which has the follow-on effect of wage inflation and the amount of ability for employees to negotiate wages and maintain a higher pace of wage growth in the market. And where we would expect to see that and continue to see that a bit is in the services side of the equation, which is what we're seeing, because a big component of delivering services is actually wage costs and employee costs, because typically people provide services. And I just, as I was doing my research for these 5 themes, I wanted to highlight something that I thought was really interesting, and that is a lot of news media we're hearing is about new immigration and new immigration helping to curb some of the jobs pressure. And certainly it will have that impact. But one thing that I learned as I was doing my research was actually an interesting feature of new immigration and its impact on unemployment. And that is that the newest of new Canadians actually have the hardest time getting employed. And so it's when you look at the statistics, you can see in Ontario has the most disproportionate amount. You have immigrants that have come into Canada or have been here for less than 5 years have the hardest time finding a job relative to Canadians who were born here. And you can see that pattern be relatively persistent. And so just something to be aware of, that some of this new immigration isn't going to impact jobs or may not impact jobs as immediately as some may purport. Inflation as a theme, you can't talk really about inflation as a theme without then talking about interest rates, because what we've seen is that interest rates and central bankers have taken the fight to inflation by raising overnight rates. And this is the yield curve in Canada year over year. So as of yesterday, Valentine's Day, 2 years ago, you can see that we just had these persistently low yields almost across the yield curve. And in a very short period of time, we've seen those bounce up. You can see, though, that the yield curve is inverted. This is, again, something that is a recurrent theme in the media. And this inversion, so having high interest rates on the overnight or very short-term part of the curve going downwards over time, is unusual, and historically has almost always been an indicator that we may be heading into a recession. What's very interesting is that this curve is even steeper than the US curve, where they continue to expect that yields are going to increase as the central bank or Federal Reserve continues to signal that they're going to increase overnight rates. And so here you're seeing that curve more increase in the short term up to the 6-month mark, and then the expectation is interest rates are going to come down. These are all sort of leading indicators, but what we're seeing is a divergence already between Canada and the US that's going to have a very likely impact on the exchange rate in terms of the US dollar strengthening to Canada as interest rates improve in the United States, where they're expected to reduce in Canada, which is going to generally move fund flows to the United States. So this is an absolute massive move in interest rates, one of the biggest ever in the shortest period of time. But I do think that the market here is generally right in that Canada is very unlikely to not be impacted more immediately by interest rates than the United States. And I will say that I agree generally with the Bank of Canada taking a pause now, because what I expect to happen is that the Canadian household and the Canadian corporations being most impacted by interest rates. I think, again, it's fairly well documented that we have a very different mortgage market than the United States, whereas the typical mortgage in Canada has a 5-year term and a 25-year amortization period. The typical mortgage in the United States has a 30-year term and amortization. So effectively, they lock in their rates for the next 30 years. And so where I see that having a massive impact for Canadians versus the US is there was a huge mortgage boom during the COVID period, 2020, 2021, as people reset their mortgages to lower rates. There are no prepayment penalties typically on those mortgages. So they could reset their mortgage to a very low interest rate and have that pushed all the way out to 30 years. Whereas for Canadians, if you are not in a variable mortgage, if you're just in a fixed rate mortgage, you're going to reset your mortgage every 5 years typically. And so every month that goes by, 1/60th of those mortgages are being reset to a higher rate. And so I think the impact of interest rates to the Canadian consumer are going to be far higher. And you can see that the household debt level that we're carrying versus other G7 countries is significantly higher. So I do think the impact of these interest rates is going to hit home faster than in the United States. And you can see here as well that early on in COVID, Canada took on a lot more debt relative to all other nations worldwide. And that was across segments. So not just the household or government, but also non-financial corporations, so non-banks. And again, this is going to have an impact of higher interest rates having an impact on costs and covering those costs. The good news is that our Canadian government's actually in relatively good shape from a debt burden perspective, certainly better than its peers in the G7. And so you can see here, though I personally think that we need to be a little bit more fiscally prudent, we are not as in bad shape as we see rates increase. And of course, for governments, they have longer term balance sheets. Not all of their interest rates are resetting very quickly. And so the cost of interest rates resetting isn't going to land immediately because they have and tend to have very long-term financing, 10, 20, 30 years, et cetera. Again, you can see here the United States, and I think the debt ceiling and what we're heading towards in June is quite important. One of the things that jumps out to me is just the amount of deficits that the US is running right now, about 8% of their GDP. Comparison to Canada, we're running about 5% of GDP. And so the United States is continuing to rack up a great deal of debt on their balance sheet. One other thing to highlight here is that we're not seeing flashing negative signals in the interest rate market as it relates to corporations. This is US data, but I think it's the analog is important to look at, and that is that you're not seeing these high yield or even investment grade rates spike relative to US bonds and bond rates. And so, here we're not seeing these flashing signals of oncoming recession or that those corporate balance sheets are out of whack and ought to be paying significantly more in terms of return than government bonds. Shifting gears a little bit, theme 3 is energy transition. I think this is going to be a recurrent theme, whether it's around decarbonization or the reduction around fossil fuels. There is a tremendous amount of capital that is going to flow into activities that relate to a zero carbon goal by 2050. So this is a number of the activities projecting out to 2050 by the International Energy Agency. And each one of these is no small feat to create. It is going to require tremendous amount of capital flows into redesigning and restructuring energy grids, redesigning manufacturing around vehicles, transportation, redesigning, remanufacturing, inventing technologies to bring down energy usage. And all of those things are going to drive capital requirement. And so as an investment theme, I just think this is an extraordinary underlying theme that's going to have wide-ranging impacts and something to be very aware of. And we're seeing that even in short-term movements in terms of energy being used in different ways, even geopolitically, and most recently with the Russian-Ukraine conflict, we're seeing the U.S. draw down on its holdings or volumes of oil to try and keep prices within a range for consumers. And again, this has a real impact on inflation, as we talked about in theme 1. So I think that from a energy transition perspective, there aren't just opportunities to invest in carbon reduction or energy utilization, renewable energy, but also even in conventional forms of energy, where I think that this dislocation of market and where funds flow is going to have a tremendous impact on other areas of the energy complex. And there are, and I keep saying it, ways to play, I think, both sides of the energy transition periodically as we move forward to this global focus on carbon reduction. Shifting to theme 4, international equities. So right here we have a chart, which is CAPE. This is the cyclically adjusted price to earnings ratio. And what that does, many people may be familiar with price to earnings. So that is all of the aggregate prices of stocks in the market divided by the aggregate of the earnings in the market. And that gives you a PE ratio. The cyclically adjusted PE ratio is something that we focus on a little bit more at Raintree Wealth Management. And that is taking the aggregate price in the market and dividing it by actually the 10-year average of earnings. And what that does is smooths out the earnings number in that ratio. Why that's important is earnings can bounce around. I mean, when you have shocks in the market like we had during COVID, the impact that that had on businesses, that can really change and make the PE ratio very volatile in how it's calculated. Whereas the cyclically adjusted ratio smooths out the ratio in the denominator. So one of the important things that I want to highlight here is just how out of line the US equity market from a CAPE perspective got. If you took this chart all the way back to, let's say, 1900, what you would see is that heading into 2022, this was the second most expensive market of all time using this ratio. The only time it had ever been higher was during the tech bubble, when companies effectively didn't have any earnings. So, you know, even this ratio got way out of whack. But this was actually higher than leading up to the Great Depression. And so this for us was a warning sign to trim US exposure and maybe highlight areas where we thought there was better value. And I know that some people will look at this and say, well, of course, the US market should be more highly valued than other markets. But that hasn't always been the case. And that's why I thought it was important to go back 20 years. You can see that markets generally traded within a range of each other. And then the US really took off over the last decade. And I don't know if people can identify why that happened. But I'll give you a hint. Why that happened was really the FANG stocks taking off in the US and technology stocks becoming a bigger and bigger component of the index. And so that was driven obviously by their tremendous amount of growth, starting to make earnings. But we're seeing that come off significantly over the last year. Still much more highly valued than some of their other markets. And you can see Canada and the Europe, EFI really, developed economies trade in about the same range, and emerging markets are quite a bit lower. And so when you look at emerging markets, just over the last 3 months, there's been a tremendous amount of fund flows, largely to China, really driving that part of the market. And that's been a very healthy area of return in the equity markets in general. This market's this side's a little bit harder to unpack. I'll try and do it very quickly. What you have here is a variety of different market indexes globally, and some just broad indexes like EFI being the emerging, or EFI being the developed markets, emerging markets, et cetera. What these ranges, colored ranges, are the 25th to 75th percentiles of where that market is traded historically. And then you have the little O, which actually is where the market is trading today. And this is also on CAPE, so the basis that we showed that other chart. And the X is what this company thinks is the fair value. This is Research Affiliates work, and they're an outfit out of the US that provides this data. But you can see here, I'm just going to pick on a couple of markets. US large cap, you can see, continues to trade at a tremendous amount outside of their historical range. And so we would see this as being overvalued. China here is trading at a very low range. And this has obviously come up quite a bit, even in the last 3 months, but continues to trade under its range historically. A couple of other emerging markets, Poland, South Korea, Malaysia trading outside of their markets, India trading actually over their market. So not all emerging markets are built the same. But this chart has changed quite a bit over time, over the last year, I should say, and you're starting to see that reversion towards the mean or average of these markets, whereas we were seeing those little circles being outside their bands in almost all cases, as markets were trading just generally outside of their historical ranges. And we're starting to see that gravitate to something that's a little bit more close to their long-term averages. My last theme is in today's market with inflation, interest rates, doing what they've done, international markets relative to maybe North America markets doing what they're doing. I think diversification pays probably more than ever. This first chart is focused on inflation correlation, and that is what asset classes do better in inflationary markets. And you can generally see a theme around real assets, being things like real estate or commodities, have performed far better in inflationary markets than, say, the stock market itself or even the bond market. And so adding real estate, adding farmland, adding these real assets to one's portfolio as a bit of an inflation hedge today probably makes as much sense as any. The other is that fixed income matters again. Up until last year, fixed income, where yields were at, it generally didn't make as much sense in terms of return driving to be very actively managed. Heading into last year, being short duration or even underweight bonds made a lot of sense. But today, with where yields are at, with governments paying in that 3 to 4% range, and with corporates, investment grade corporates paying in that 5 to 6% range, it's pretty decent returns again. So, I think oftentimes we look backwards and we think, oh, geez, well, that doesn't look very good. It was such a tough market in the fixed income market last year. Better not, invest any more time looking at that part of the market. I'd say very much the opposite. I actually think fixed income is very interesting again, and is going to be a growing part of an investor's portfolio moving forward. Some people are talking about, rebalancing the old 60-40 portfolio to a 40-60 portfolio, that being equities to fixed income. And I think there's some logic in that in terms of setting in or locking in interest rates in part of the portfolio. We're actively managing that part of the portfolio where there's a real dispersion now between the types of returns you're getting on the short end of the curve versus the long end of the curve. So I think fixed income is meaningful again. And I think, this is the 2020 projection from Cowen. I always like highlighting this just in terms of how much has changed over the last 30 years from an investment management perspective. It used to be that you could allocate a significant portion of your portfolio to fixed income. This is obviously US data, but Canada wouldn't have been that dissimilar in this case, and generate a pretty good real rate of return. So that's inflation adjusted. Over time, the complexity in the portfolio generate that type of return has changed quite a bit, and seeking out different types of investment classes has become, I think, more and more important to the Canadian investor. And so I hope that you will think about that today as you listen to some of the investment managers that you're going to hear from in terms of how adding a component of their investment might impact the overall mix in your own portfolio. That's the end of my presentation. Jay, I'm going to hand it back over to you. I don't know if we've got any time for questions.
We've got a couple of minutes. We'll start off, Peter. You mentioned your 5 themes: inflation, interest rates, energy, international equities, and diversification. Talk to me a little bit about what you're most optimistic about going forward into 2023, into 2024, about how we're managing the portfolios, and where do you see the opportunities going forward?
Yeah, I think a couple of areas. Themes to think about. First one is value investing. I think there's a tremendous opportunity. We've seen a big rotation between growth and value investing, both in the US and Canadian market. And I think even with some of the private investments that we have, there's a value theme to some of them. Revesco from a real estate perspective, Skyward from a private equity perspective, really value oriented. I'd say real assets, again, that inflation piece. We've got a number of investments that focus on real estate, on farmland, and just buying, businesses that are more capital oriented businesses. I think are going to outperform here over the next stretch. As it relates to Raintree Wealth Management and how we have our portfolios positioned from a public markets perspective, I think, of course, highlighting international and emerging markets, we're overweight. So we think from a valuation perspective, there's still room for that trade to move. Small cap, very excited about that. We actually just added small cap in December with a new manager, and really excited. Again, it's sort of a value play. The valuations came off so much, both in Canada and the US over the last 15 or 18 months as the market's corrected. And we just think there's a really interesting deep value play in small cap where the return profile should be pretty healthy. And then on the fixed income side of the equation, pushing out duration and exposing ourselves to the longer end of the yield curve. We've started to do that. I think that's something that we'll continue to do moving forward here. And I always like to highlight preferred shares as being a really interesting segment of our portfolio. We've been in and out of that position 3 times. Sort of overweight and underweight over the last 5 or 6 years. And from a timing perspective, you're able to generate, 8 to 10% returns owning some really high quality businesses here in Canada. And I just think that's going to be a great trade, whether you're generating the interest income, dividend income, or some capital appreciation that may come about as that segment of the market gets a little bit more love moving forward. So really excited about the return profile there.
Right. I think we've got time for one more question, Peter. I've talked to clients, and you have as well, who have seen some of the headwinds you mentioned, inflation and some others. Are there alternatives at RWM, that places people can invest in outside of the traditional investments, who are maybe a little skittish and want to be on the sidelines for a bit?
Yeah, well, two things to comment on there, Jay. I think one, we just launched a high interest savings account. So for investors who are looking to park some money on the sidelines, but generate a pretty healthy return, call it 4.2% right now, net. We've opened that up to our clients. We've actually seen a tremendous amount of flow as a result of that. And I think, for clients that want to park some money, I think that's important. I will say for clients who are thinking, geez, I just want to run for the hills and I want to park all my money, I want to caution that type of activity. Sure. We at RWM use other strategies to manage some of the volatility in the portfolio, try and seek additional sources of return. I talked about pref shares, international. But even our tactical allocation, and that's managed by Larry Berman, he generated a 15% or so return in our portfolio last year during one of the worst equity markets that we've seen in a generation. So, having that type of allocation, I think, if you're not invested, you're not able to expose yourself to that. Same thing with absolute return. As we see this volatility in the market, we have a larger than maybe typical absolute return component to our portfolios. And what that means is really hedge funds, but they're going to benefit through these volatile market conditions. We expect, obviously I can't promise that, but our expectation is that. And again, I would expect that having that allocation as a bit of a ballast to a portfolio in more volatile conditions, I think is a real benefit to our clients.
Great. Thank you very much, Peter. There are no more questions at this time. Again, if there are any questions that do come through, please forward them to either us directly or to your private wealth advisor. Thank you, Peter, and we'll be moving on to our next speaker. Our
Thanks,
next
Jamie.
speaker, thank you, Peter. Our next speaker is Michael Denny, Managing Director of Link Equity Income Trust. Michael, with that, I will turn it over to you.
There we go. So I just shared my screen. I think you can see it, can't you?
Yes, we can. Thank you, Peter. Thank you, Michael. Yeah.
Okay, great. Just move this around here. So thank you everyone for spending a few minutes with me today to listen to an introduction to Link's Equity Income Trust, or perhaps for those of you that already know us, to give you an update in some of our financial performance and how we're doing. So to start, I have to go through some legal notices. The print is very small. I would encourage you to download the presentation from the web or get it from your financial advisor, who can go over the forward-looking information risks, the risk factors, and also the redemption options. So what I'm going to do today is I'm going to give you a quick overview of who we are and what we do. And then I'm going to give you 3 reasons why you should consider speaking to your financial advisor about adding us to your portfolio. So we are one of Canada's largest corporations. Last year, we were 478 on the Financial Post list of the 500 largest companies in Canada. We got there with $591 million in revenue, about $47 million in EBITDA, which is effectively pre-tax profits. We have over 2,000 employees. We have 4 institutional investors, and we're backed by about 1,400 individual investors across Canada. Now, what we do is we buy small and medium-sized businesses from retiring owners. We're a buy and hold investor. We buy companies with no intention of ever selling them. We buy companies that are relatively small, somewhere between $750,000 to $3 million in pre-tax profits. We've been doing this for 16 years. And over those 16 years, we purchased and we now operate 53 businesses in Canada, in the United States, in the United Kingdom, and in Denmark. And the Link's Equity Income Trust, which is the opportunity you have to invest alongside us, is backed by our 15 US-based companies. Now, the question then is asked, what kind of companies do we buy? Well, we only buy strong, stable businesses that are run by quality people. We are interested in businesses that have been around for 30 years and are going to be around for another 30 years. We're interested in companies that have great people because our business is based on the quality of the people that we can bring into the fold. We are not interested at all in any company that's a turnaround or any company that has challenges or any startups, only companies that have good long-term industry fundamentals and have a committed and experienced management team. The retiring owner has to stay on also for 2 years or perhaps longer to help us transition operations from his control or her control to the new president. We're industry agnostic. We'll buy companies in any industry as long as they're not resource related, technology related, or real estate related. And so here's our founder, Brad Nathan. I encourage you, all of you, to go on our website and look at some of the interviews that he's given in the Post and in the Globe and Mail. It really give you a flavor for the philosophy of our company and the fact that our company is fundamentally based on a great group of people. Here's the 38 people that work at head office. And in addition to them, we have over 50 presidents of the individual companies which we operate. And that's one of the tremendous strengths of our company, is that when we look at a new acquisition, we almost always have a president of one of our associated companies who we can go to and help us do diligence on that acquisition and make sure that it will fit into our fold well. So I'll give you just a quick snapshot, a quick look at the 15 companies in the US portfolio before I give you those 3 reasons why you should consider adding us to your portfolio. You know, our most recent acquisition we just announced a couple of weeks ago was Booz Timber and Sales in Seattle. They've been in business for 75 years. They're a specialty sawmill in the Seattle area. Then in December, we announced an acquisition of Resource for Floors, which is a flooring contractor in Fort Lauderdale. They've been in business for 40 years. Those are our 2 newest acquisitions. Our older companies, GW Commercial Interiors in Seattle, in business for over 20 years. Flooring Solutions in Livermore, California. They've been in business for 30 years. Floor Solutions in Portland, 25 years. Wine Valley, which is probably our largest company. They're in Seattle as well. They're a siding distributor and other trim products. and they've been in business for over 65 years. United Fastener in San Diego is a fastener distributor. Intermountain in Utah is a facility maintenance company. So they do a very simple business of, shoveling the snow and cutting lawns and cleaning offices in the state of Utah. We have a trucking company in Michigan, Maverick Trucking. We have 5 small companies, but they're early acquisitions of ours in the retail and related industries. I put them all on one page because they're not that big. To give you a quick snapshot of the financial performance of our U.S. portfolio, which backs the trust, our flooring group, which is now 6 companies with the Fort Lauderdale acquisition, last year did $194 million in revenue and had $14 million of EBITDA. Our construction and industrial distribution, which will be included, which we'll put Booz Lumber in, last year had $33 million in revenue and $5 million in EBITDA. The 5 small retail companies I mentioned had about $1 million in EBITDA, so they are small. And then our 2 business services companies had $21 million in revenue and just over $2 million in EBITDA. And then when you look at the historical performance in the U.S., you can see that here on this chart, we entered the U.S. market in 2013 with $7 million of revenue in our first acquisition. And now in the most recent fiscal year, we hit $268 million in revenue. So it's been incredible growth. You can see during the COVID, things were slow and we didn't acquire any new companies, but we are clearly on a track to do another 25% increase in revenues this year. And over the over all the years being in the States, over the 9 years, we've had compound annual revenue growth of 50%. So a tremendous success story in the States. So now the 3 reasons why you and your financial advisor should consider adding links to your portfolio. The first reason, the punchline always is, what kind of return have you paid? Well, we paid a very attractive historical return. We still have an attractive target return. And we also have a structure in which we reward our longest term investors more than the investors that join us immediately. And I've got this chart. It's a little complex, but along the left-hand side, you can see the year in which people invested in our company. And then across the top is the return that they were paid in each year. And so you can see that our oldest investors are from 2016 in the trust. And over the years, they started 8.5% and they've increased over the years. And so currently, they're receiving a yield of 9.62% on their units. And whereas our newest investors, we start off at a yield of 8.25%. And then every year in the June quarter, we evaluate the performance of the US portfolio. And if we've had positive organic revenue growth, then we increase the yields on the units. And you can see that in 2022, we increased the yields across the board by 10 basis points approximately. The second reason you should consider adding us to your portfolios is that we have significant free cash flow, which backs the distribution. We aren't stretching to pay our distribution. We have substantial cash flow because all our businesses are profitable, and we use that profit to buy new businesses. But before we buy any new businesses, we use our profit to pay the distribution to the investors. And you can see here, I have a schematic on the left-hand side and I have the hard numbers on the right-hand side. And you can see last year, pro forma with our 2 new acquisitions, we have $26.8 million in pre-tax profit. If you go down the list and you look at all the fixed payments we need to make to the bank, to our lessors, and to our earnout payments on companies we've recently purchased, we still have $11.5 million in free cash flow, of which there are $4.3 million in trust distributions, which basically means we have $2.71 worth of free cash flow for every dollar we owe investors, such as yourselves. And that is a tremendous margin of safety, which protects the distribution that we're paying you. Now, the third reason, and maybe this is perhaps for many investors the most important reason, is that we are structured for capital preservation. Not all investments work out. Sometimes mistakes are made and bad things happen. And so you want to look at an investment that provides you with a significant margin of safety. And so one thing to remember about us, perhaps maybe the most important thing, is we are not a traditional fund like many of the other investments that you may consider for your portfolio. We are not a fund in the sense that there's a manager that raises a pile of capital and then takes a management fee off that capital. We are a corporation indirectly, so that when you invest in our company, we control that capital and we use that capital to help us buy additional companies. What that means is that if we ever make a mistake or something bad happens, like a recession or one of our companies goes bankrupt, the loss is incurred by the owners of our company first, before any loss is incurred by the trust investors. And I have the schematic here on your screen, which shows that in the US, we have approximately 71% owner's equity in our capital structure, which is about $150 million. And that protects the $29 million that we've raised from investors such as yourselves. And that's a tremendous margin of safety, a tremendous safety margin for you to think about when you're making your investment decisions. And that's really it. Those are the three reasons. We have an attractive historical and target return, and we reward long-term investors. We have significant free cash flow backing up our distribution. $2.71 of free cash flow for every dollar we owe investors. And then lastly, we're structured for capital preservation with approximately 70% owner's equity backing up the investors in the trust. And that's it, Jay. I'm happy to take questions.
Thank you. Yeah, we don't have any questions. I do have a question for you right now, Michael. It talked about the structure of the organization. Can you talk about, optimistically, directionally where you see some of the investments going in the future, and where are some potential pitfalls you could potentially see as well?
That's a good question. I'd like to say that we have a grand strategy. I know other private equity like companies like ours have a theme where they're acquiring companies in one vertical. That's not how we operate business. We're very opportunistic. So we go into verticals, or we go into companies that we think are good long-term investments without really looking at sort of a strategy behind it. So one of the advantages that we offer investors is that we are really well diversified. We own a lot of flooring contractors, but those flooring contractors are spread across the whole US market. We own companies on the West Coast, companies on the East Coast, companies in the Midwest. So, every year some of our companies underperform and some of them outperform. I think right now we only have, of our 15 companies in the States, only one is in a loss position. It's one of the small retail companies. It's lost this year less than $100,000, so it's not a major problem for us. But our businesses compete locally. They don't compete internationally. They rarely compete nationally. They are businesses that can react well to an inflationary environment because we can raise prices. We're not we don't touch commodity-related businesses. They're businesses that actually do well in a recession as well, do relatively well in a recession because they don't have hard fixed asset costs, and we can, in a bad environment, lay off staff. So I don't want to say that we aren't worried. We told all our presidents to be on recessionary footing because interest rates are high and people worry that the U.S. market will make a soft landing. But there aren't any of our businesses that unduly worry us right now. Yep. I'm sorry, that's not the answer you're looking for.
No,
that's the truth. That's the truth of the matter.
Yeah, that's great. We actually have a few questions come in. The first question we have is US versus Canadian dollars on your investments. How do you manage the currency exposures?
We're naturally hedged because you as an investor are investing in the trust, which is backed by the US portfolio. But we do have a Canadian operation, which is almost as big as the US. It's slightly smaller. And we have a European operation as well. So we have cash flows on 3 continents, right? So we're naturally hedged. So we don't really incur any significant currency exposure or risk.
Another question that has come in is, can you comment on how you differ from other groups who are trying to acquire good small companies? It seems that most PE type private equity firms type organizations are looking for the same type of business as you are trying to buy. So they're looking for, what is your differentiation?
Oh, it's right here.
Okay.
It's right here. I'll go back to my page. There are very few private equity firms in Canada, the US, or in Europe that will do this. $750,000 to $3 million. Like that is in the private equity world, that is really, really small. Booz Lumber will do about 1.4 million in profits this year, and Resource for Floors will do about 865 in profits. Those are so far under the radar screen of traditional private equity firms that we don't have any competition. Like when we go in to buy a company, there is usually no one else at the table, because the big money firms, the other private equity firms, they look at the companies we buy and they say, it's too small and too much trouble. I think at some point, other buyers will see what we do and will come into our market. There are a couple of others that are out there that kind of do what we do. They're much smaller than we are. But the thing to also remember is the market is so massive that we never bump into them.
Okay.
Yeah, like most of our acquisition, this is the other thing that just, when we talk to people, they just find it very hard to believe. Our acquisitions generally are done at 4 times earnings. Like, I mean, Jay, think about that. I mean, you think about how much money you can make. Generally we see a business that's, got $1 million in pre-tax profits. We can buy that business for $4 million.
Right.
And one thing investors, often forget is that what makes a great investment is not buying into a great company. What makes a great investment is paying a great price.
Yeah, great point. Next question has come through. Looks like there might be an economic slowdown. Seems that flooring, siding, cleaning are all businesses that might be affected. A business is more likely to have their fire system, elevator services, than their lawn mowed and redo the flooring. Can you comment? So I guess they're looking at is the different aspects of the market.
Oh yeah, no. Listen, if there was a recession in the US, our profitability will go down, no question. I won't argue. I'm not going to argue that point. But what you do as an investor is you take comfort on this slide here. Even if our profitability came down, we still would be, not getting near where we wouldn't be able to make distributions of the trust. Even if a recession happened and 2 of our companies went bankrupt, we still wouldn't, destroy enough owners' equity that the trust investors would be at risk at their principal. And if you look at what happened during COVID, where are my numbers here? My numbers are back here. Here we are. Sorry. Look, we had a turn down in the business during the COVID crisis, but it wasn't such that we got anywhere near, the distributions or the principal being at risk. Matter of fact, one of the neat things about our business is because all our businesses are profitable, when a recession hits us, when COVID hit us, we stopped buying companies. And if we stop buying companies, cash just piles up on our balance sheet. The only reason we raise money from outside investors, such as the clients on this call, is because rather than buying 4 companies a year with outside capital, we can buy 8 companies a year. But in a recession, we'll stop buying companies, and therefore cash will collect on our balance sheet. But yes, your investor's question is quite correct. All our businesses will do less well during a recession, but because we're not highly levered, our businesses are not at risk.
Understood. Next question that's come in is from a client, investor, sorry. We're previously invested in Temperance from Lynx.
Yeah.
If we expand our holdings, would we retain the current return, or would the new holdings be rewarded with the 8.25% return?
8.25. New principal investments start at 8.25, even if an investor has an older unit yielding 9.5.
Okay. I think that's all we have for questions thus far. Michael, thank you very much for your time today.
Always a pleasure. And I have on the last slide here my contact details. I encourage anyone to speak to their financial advisor about Lynx. And if you want to contact me directly, I'm also happy to speak to individual investors as well.
Thank you very much, Michael. Appreciate your presentation. It was very well done.
Thank you. Take care.
Thank you. Our next presenter is Gabrielle Millard from Senior Vice President of Capital Markets, Equity and Research at Avenue Living Asset Management. With that, I will turn it over to you, Gabrielle. Hi, Gabrielle, can you hear me?
I can hear you. Yeah, can you guys hear me?
Yeah, perfect. The floor is yours.
Perfect. Thank you very much. And I will start to share my screen here. And can you see that?
Yes, that works. Thank you.
Perfect. Well, thank you. And thank you everyone for coming to hear the presentation today. Today, I want to talk about our second farmland fund, which is going to be called Tract Farmland Partners. Many of you are most likely aware of Avenue Living, as well as probably our first product, which is the Avenue Living Agricultural Land Trust, which is approved on the Raintree Shelf. So I will start by going over a bit of a background in terms of Avenue Living, and then we'll dive into different types of farmland investing, and as well as just dive into the farmland investing space in general. So jumping ahead here and just wanting to take a step back, Raintree has been a very, very strong and positive partner for the Avenue Living Group, and we've been very excited to be in partnership with them for, I believe, over 5 years now. But really wanted to take a full step back for those who may not be aware of who Avenue Living is, or maybe hasn't heard an update on the Avenue Living Group in some time. So just to provide a nice high-level overview, the Avenue Living Group we were founded in 2006, very humble beginnings, 3 co-founders, had a little bit of capital from some condo conversions and just looking for a place to park that capital and clip a bit of a coupon as almost a retirement plan. That quickly turned into something that is much larger at scale. At that time, it was one 24-suite multifamily product in Brooks, Alberta, which is a small town just southeast of Calgary. And what they recognized, though, was that in what they were able to accomplish, which was really going in, buying a bit of a broken asset, fixing it up, and pulling out the equity, they were able to achieve pretty significant returns and found a number of very unique niches within the prairie landscape. And really from there, the co-founders, all 3 consummate entrepreneurs, decided to really bootstrap and see what they could turn this into. And they spent the better part of the next 10 years growing across the prairies, focusing on small towns, multifamily. It was purely a private family-run business at that time. There was a little bit of private debt, but no external investors. Since 2016, 2017 timeframe, they recognized a number of things. One was the Avenue Living strategy had always been one of vertical integration. And so what I mean by that is everything in terms of the property management side was handled internally. So whether that was leasing, whether that was maintenance, that was all done internally. But also was done internally was the legal side of it, was also the accounting side of it. So we had a very large accounting, a very large legal team in order to manage all of the transactions that were done throughout the prairies, and wanted to really try and leverage that capabilities. So that was when 3 new funds were formed. There was the Core Trust product, which many of you are most likely aware, which is our multifamily product, really the backbone of the Avenue Living Group. The Opportunity Trust, which was another vehicle in order to go in and acquire broken assets, and the Agricultural Land Trust, which also many of you are most likely aware of, which was to invest in farmland, predominantly in Saskatchewan, on a passive basis in order to have exposure into the farmland asset class. Since then, as you can see by this map, we've actually launched another new fund, which is mini mall self-storage properties. And really, since then, we've really taken off. And you can see we're now no longer just a prairie story. We're all across Canada and into a large portion of the Southeast US. We're actually in over 1/3 of the provinces, territories, and states across Canada and the US. So strong operations, Calgary headquartered, Texas-based headquarters for our US operations, and Toronto-based headquarters for our equity operations. now about just over $4.6 billion in total assets under management over a 16-year track record, and nearly $2 billion in terms of total equity managed. And then one unique piece that we continue to see, that we have seen since the beginning, is that the founders' capital are still very much aligned. So the founders group had been invested in the Avenue Living Group, and this is still their main and core business, and they're invested alongside all of their employees and all of our investors. So it's really exciting to see them pari passu and really going alongside for the ride. So they are in the business every day from 5 a.m. to God knows when at night, and it really is a nice thing to see the alignment in that side of it, of a very extreme alignment. But today, I want to talk about our farmland. And we'll start by talking about our trust and giving a nice update in terms of what the Agricultural Land Trust has done over the last year, and as what we're looking to as we start to end near the final period of our investment horizon for the Avenue Living Agricultural Land Trust. So this idea for this fund was really formed through a connection of our founder, Anthony Giuffre, as well as the CEO of the Agricultural Land Trust, Leif Sneffen, who he himself is a third-generation farmer, and was really recognizing a strong opportunity for a capital provider to come into the space within the farmland space. And really what the trust does is something quite simple, is we purchase farmland assets, and we rent them back to farmland operators. Now, as you'll see throughout the presentation, what's in theory very simple comes to be quite difficult as you try and figure out, where are you going to buy these assets? Who are the farmer and operators you're going to rent to? How are you going to provide value for them so that they choose you as the owner versus somebody else? And this is really where the secret sauce of the Avenue Living Agricultural Land Trust comes into play. So the Land Trust was formed in 2016, and we now have 83,000 or just under 83,000 acres under management. For a little bit of context, that's actually larger than the island of Malta as a landmass. So it's a pretty extreme landmass in terms of the ownership. And you can see here on the left-hand side of the screen on the map, we're pretty evenly spread throughout throughout the province, which is really important for us in order to ensure that there's diversification across the province in case of any adverse weather effects. I mean, when you think of Saskatchewan, it's such a massive landmass that there is differing weather patterns and farming patterns across it, depending on which quadrant you are in. So it's very important that we see diversification across, as well as areas that are strong farming areas. On the right-hand side, what you'll see is our crop breakdown. And now this is a 5-year average within Canada. You roll your crops on a rotational basis, so it's not always the same products being created. But you can see here we make up, canolas 34%, hard red wheat 25%, lentils 11%, durum wheat 14%. And what's really is some of you might recognize some of those products as really being Canada's major export for the global food supply. So if you take, for example, lentils, Canada and Saskatchewan actually as a province represents 51% of the total global food export for that. Durum wheat is about 35% coming from Saskatchewan. And when you take that another step further, you start to see that really the other markets that are a major player within the food supply of this tend to be those BRICS nations. So Brazil, Russia, India, China, that for unfortunate reasons, there are a lot of geopolitical issues that we're starting to face. And Canada and Saskatchewan, as for that matter, really represents a significant portion of the global food supply. So really, we're going to see over the next coming years that Canada and the Saskatchewan province are going to play a major role in food and global food security. And that's one reason that we're so excited and so proud to be within this space, and doing so in an active management way, which we'll talk about, really helping out the farming operators that we work with on a day-to-day basis. So just a little graph here to show the growth of the fund. I mean, first assets were closed 2017. starting out at just under 18,000 acres with a capital injection from the founders, as well as our equity partners. And really, it was a bit of a steady growth trend as we started to, understand the space, started to build a reputation for ourselves of being able to close and being good managers within the space, as well as working through with our debt relationships in order to continue to improve, to create a more fulsome debt product. And really, 2022 was when they came into our own. We purchased a large acquisition from, it was actually the last remaining piece of CPPIB. Their Saskatchewan holdings were able to purchase out the remaining piece that they had there, which were just orphaned assets for them, to really, really grow our portfolio into what it is today. So it's been a very exciting growth trend, and showcasing that, we've now spent a better part of 5 years or 6 years within within this space, and during that time have really built a strong reputation for the Avenue Living Group with the farming community, and we'll talk about why that is a little bit later on. And then just here, just showcasing how that has performed. Saskatchewan farmland has been historically a very strong investment class, although very much not talked about, a very bit of a unique niche of an investment class, but really, really powerful returns, and especially over the last 3 years, as you can see here, 1 year trailing over 20%, 2 year annualized almost 20%, and 3 year annualized up at 14.8%. So we've seen a very strong return. Really, that started in about 2020 when that started to happen, but we'll see how throughout the presentation that these types of farmland appreciation, whether it's Saskatchewan or whether it's the rest of Canada, has really been happening for an extended period of time, and we'll talk about some of those reasons why. But just wanted to highlight, the strength of the original fund, and we can get in. I'm hoping to leave plenty of time for questions afterwards. So anyone that has previously invested into the land trust, we will absolutely be able to answer any questions that you may have about, where is this performance coming from, or what are we looking to as we start to wrap up at the end of this year in terms of what the trust offering looks like. But with that, I want to dive into, why would you invest in farmland, and why would somebody look at investing in farmland? Now, it's one of those pieces where it's actually been, a preferred investment vehicle or a major investment vehicle for some of the ultra high net worth and largest institutions. I talked about how we acquired the last remaining piece of CPPIB in Saskatchewan. That had more to do with political reasons for why they were getting out and why we had our opportunity. But they are major investors within the farmland space. You have some of your ultra high net worth private individuals, such as Bill Gates, who is the largest private landowner in the United States, have been investing in the space for a number of years. And the reasoning why is quite simple. First of all, it's got a very strong potential to be a strong inflation hedge, or protect as what quote unquote safe haven asset, as it has historically outperformed CPI for the better part of the last 20 years, which is a very strong return. As well as we've seen, because of that steady return that it has historically seen, it tends to be non-correlated to some of the public equities that tend to flow with the business cycle. So it doesn't have that same high, and also doesn't have that same low that you can sometimes see within the public equity markets. It also, unlike some of other areas, such as, say, raw land, farmland has an income stream. So it's got a stable or relatively stable income stream because you're collecting rents from the farmland operators. So it has an intrinsic value that you can value this based off of, rather than just other potential safe haven assets. People will consider things like gold or other kind of commodities or collectibles as safe haven assets, but there's no intrinsic value there, whereas the farmland space actually generates an income stream from the farming operators. And additionally, it's actually a very defensible income stream because of the food security piece of the operation. The global governments, especially the Canadian government, has enacted very strong form of crop insurance. ensuring that farmers can continue to operate in case there's any adverse weather effects. And so what this means is when you're renting an operation, and we ensure that all of our farm operators have this, is you've got crop insurance. And that crop insurance enables a farming operator to be reimbursed for their crops in case that they were affected by any adverse weather effects. And the amazing thing is, because we've seen such high increases in the inflation during these inflationary times for these crop products, the actual insurance that's being paid out on this is many times higher than what you would have received on market just 2 or 3 years ago. So it's a very interesting time within the space. So what else is happening within the farmland space? Right now, what we're seeing is a large consolidation. Canada is not happening in the same way as the US. We're still a little bit behind, but essentially what's happening is, in the farming space, if you are not expanding, you are getting out of the business. And the reasoning for that is quite simple. Either your kids have grown up within the community and are excited about farming, and you're looking to be able to pass this on as the general age of your farmer gets up to into the 60s and 70s, and they're looking to pass on that operations to their kids. Typically, you've got 2, 3, 4 children that you're looking to pass this on to. You can't pass on your single farm in order to that. So you're looking to expand into the neighboring communities. Or conversely, your kids had wanted nothing to do with the farming space. They went out somewhere else. They're working at Silicon Valley and the next tech startup, and they want nothing to do with farming. And you are now getting to a point where it's a little bit difficult to manage this by yourself. So starting to look to age out. So that's how it's happening in terms of, and starting to get that liquidity. So that's typically where we see our transactions happening, is one of the neighbors wants to expand at the same time that a neighbor wants to get out of the business, and they'll come to us as a capital provider in order to acquire the entire farm and allow them to expand their operations. So what we see here on these charts is that the average farm size is continuing to increase, while the number of farms has drastically decreased over the last 100 years. Additionally, as Canada's population continues to grow, but cities continue to expand, the arable land per acre has continued to decrease on a very drastic scale over, again, the last extended period of time here, 50 years. A couple other macro trends that we're seeing outside of just the Canadian farming space, but really more on the demand side of the business, is the growing world population that we always continuously hear about. But another interesting fact that we see is that that isn't talked about a lot is within the developing nations. And as developing nations reach a higher GDP per capita, and what you can see is there's a real inflection point of once you reach a specific GDP per capita, where you start to demand more food products. And there's a strong correlation between a higher GDP per capita and the calorie intake per capita. So not only are we seeing expanding world population growth, we're also seeing an expansion of the growth of demand for calories per capita on a daily basis. So these two trends are converging at the same time as the previous trends, where farming operators, where they're starting to consolidate, to really create a very unique space for farmland valuations. And what does that mean? Showcases directly here on the right-hand side, where the light yellow bars represent the Canadian farmland annual return as measured by FCC, which is the Farm Credit Canada. So this is just a general across Canada farmland space. You'll see in a chart later that the prices do vary wildly between provinces, but this is a general annual return. Comparing that to the right-hand side, or to the darker bar, which is the CPI, percentage annual change, so your measurement of inflation. And you can see historically that the farmland annual return has drastically outperformed CPI by a significant margin on average over the last 20 years. The two interesting pieces that we see is there's really only been, since over the last 20 years, there's only been 1 year where the farmland appreciation did not outperform CPI, as well as even for those times where there was deflation. You look at 2008, 2009, where the CPI dropped, we actually continue to see farmland appreciation during that period, not as high as the year before, but continued to appreciate. So showcasing that historically, it has been a very defensible asset class. So why would somebody want to invest with Tract Farmland Partners LP? Again, this is our second generation of our farmland fund, so a new fund. And why would somebody want to invest with us versus some of the others? Realistically, your first piece that you're seeing is our senior management team. These are faces that many of you who are familiar with the Avenue Living Group are going to recognize. It's the same management team. We are creating a new fund, but the same management team is in place with the same individuals and the same expertise that you've been investing alongside for now the better part of 5 years. So we've got Leif Sneffen, who's our CEO. He is himself a third generation farmer. He, now being in this space for an extended period of time, has built a very strong reputation within the community as really being an owner who is an operator first style. And so what I mean by that is the other two management teams here are the other two individuals who represent our senior management, Anthony Giuffre as CEO and chairman of the Avenue Living Group, and Jason Jogia as chief investment officer across the Avenue Living Group. And oftentimes ourselves and everyone at head office, we can think of, well, why aren't we jamming rents all the way? Why aren't we continuing to jam rents? And Leif is always very, very pro farmer, ensuring that we reach our target yields and our target returns, but also that we're doing so in a way that sometimes when you're removed from the operations, it's easy to miss. And so because of that, it's really paid dividends over the years. And we're starting to see most of our deals are now coming off market because of, one, the land mass that we have created. So if it's somebody that is already renting from us, that's looking to expand and has found a deal, they will come to us first. Or it's somebody that's heard of us in the community and is accepting that, we are somebody that understands them. We are not just a, faceless organization that's head office in New York or Toronto or somewhere that is just purely coming in on a capital play. We are there for our operator, and we actually invest in our operations, which we'll talk about in a second here. So what's the strategy for farmland? The strategy, as we've talked about at its highest level, is acquiring farmland and renting it back to the farmer. When we dive a little deeper, where our niche and where our value add really comes in is not only choosing the correct assets themselves and finding out, which farm do we want to be a part of, what location do we want to be a part of, but also understanding what can we do in order to help improve the operation. So where can we invest alongside the farmer in order to improve their operations? And that's activities like land clearing, tree clearing, land reclamation projects, oil and gas surface revenues, a number of different pieces right there where really small capital investments can actually generate over and outsized returns for the operator, because you are getting a multiple on the operations that you're able to improve upon. The other piece here is, we do invest purely in Saskatchewan. It has, on a whole, outperformed the rest of Canada on a 10-year period, so 11.8% compound annual growth rate versus a 10.64% for the rest of Canada, as well as we do use leverage. So what I mean by that is we use strategic leverage in order to provide our investors a levered play on the farmland appreciation. So we are going out, we're providing debt. Our operations typically yield about a 4% yield at acquisition on our farm operators. And so we're able to service our debt costs through the operations from the farmland. And then that provides our equity investors an exposure to a levered play on top of that farmland appreciation. So why is Saskatchewan outperforming the rest of the country on a percentage basis? Well, this is the main reason why. If you look at the price per acre, Saskatchewan is one of the lowest or the lowest province within Canada. It is up to 30% less than Alberta and Manitoba, although both of those provinces have very similar soil qualities. It's drastically lower than Ontario, as we can see here. But because of that base effect, although it's seeing similar price appreciation, because it's on a lower price point, we're seeing a higher percentage return for that farmland space. So what are we looking at and what have we done so far? So Tract Farmland Partners was actually formed in late December. We have acquired our first assets, about 800 acres of farmland space. And we already have built up, again, I was mentioning Lace reputation and Tract and Avenue Living Group as their reputation for the farming space. And we've already built up a strong pipeline of just under $21 million and 6,600 acres of potential acquisitions that we can close on. So we're very excited about the potential growth for this fund as we quickly want to amass assets within our newest portfolio. Then just a quick piece on what these offering terms are going to be is really, I mean, this is a fund that is a capital appreciation play. So I mentioned earlier that we are doing a levered play and we are using the income from the farmland to service debt. So because of that, there's not a distribution that is paid on this. This is a capital appreciation play. But really what drives, and I'm just going to pop back up here for a second, really what drives our returns is the additional alpha. And so it's this last point here that I want to touch on. It's the additional alpha that we are providing for our farming communities. And so I mentioned that it's, things like tree clearing or land reclamation projects. But we're not just going in and purchasing a farmland space and renting it out passively to the farmer. We're taking the same thesis that works for Avenue Living Core Trust on the multifamily space and providing an asset plan. When we go to buy a multifamily building, we're not just going to go and buy it and let it sit. We're buying it with a plan, a business plan, in order to improve the operations so we can improve the rents. So when we buy a farmland or we buy a tract of land, we are going in there with a viewpoint in order to improve the asset. So whether that is, yes, your land reclamation, we've got areas where we've invested in grain bins. We've got areas where maybe there's a portion of the acreage that is unfarmable. How can we go in and help improve that so we can expand the entire arable land within that acquisition? So it's something that we go in always with a business plan in mind. So again, going back to it, target returns are in that 10 to 14% range. Capital appreciation play, minimum investment $25,000. With that, I would love to be able to open this up to any questions, and happy to answer any.
Thank you very much, Gabriel. Yeah, we do actually have a couple of questions that are on the board. The first question is, can you comment, please, on the exit plan for Ag Fund 1?
Perfect. Yes, absolutely. That's a great question. So the Ag Fund 1 is scheduled to wind up at the end for a liquidity date as of December 31st, 2023. So that is at the end of this year. And right now, although I will preface that this is still, there's a couple of different options that we have, but the plan is to provide all investors that are looking to get off the bus. We understand that it was a fixed sunset fund, so there were there's no redemptions, early redemptions. So any investor that would like liquidity, we will be providing them that liquidity option. We would also like for any investor who does not want to have liquidity and is looking to maintain on the investment, doesn't want to have that tax consequence if they're in a non-registered plan, in order to continue to invest alongside. So what that means is that anybody that requests redemptions will be able to be paid out, and everyone else will be set on to, will create a redemption schedule, whether that's say $2.5 million per quarter, probably is a rough number that we will look at choosing. And in order to fund those redemptions, the land will be sold either to Tract Farmland Partners it'll be sold to the market, and we'll be setting up a nice governance structure in terms of creating independence on both sides of the funds. They'll be done based off of appraisals and transacted at the third-party appraisal value. So those are the two different options, whether it maintains in the portfolio, if it's a piece we want to continue, or if we can receive a better price, if we go to market, we'll go to market.
Great, thank you. Our next question is, are there large, massive farming corporations in Canada, or are still the market predominantly family-owned businesses?
Yeah, the market as far as the actual farmland operations is still predominantly family operations. Now, some of these family operations are very large, but it's still predominantly family operations, unlike the United States, where, yeah, I believe it's 3 or 4 major players represent the bulk of the operations down there. Canada, thankfully, has not gone down that road yet. But we are definitely consolidating into larger family operations, and have been seeing that for a number of years now.
Okay, thank you. Our next question is, when you invest in grain elevators or surface energy, does that affect investors in the trust/LP, or is that a side deal between Avenue Living and the farmer?
Nope, that's directly to the trust. So typically those types of operations will do 2 things. One, it'll tend to improve the output for the operator, which means that we are able to achieve a higher rent because they're receiving a stronger yield on their operations. So that means that our yield or our income off of that operation is higher, which then correlates into net income, correlates into returns for our investors, as well as the beautiful thing about it is that there's now a value that's applied to this. So, if you think of a grain bin, there is a value and a multiple that can be applied to this, and that is done through our appraisers. So you start to see continued valuation lift because of those types of investments.
Understood. I'll have a question for you, Gabriel. You talked about the consolidation in the farmland space, primarily in the US. How do you see that playing out if there is a recession that occurs? Do you see that consolidation place slowing down or escalating in a recessionary environment?
Yeah, I would see that actually escalating if that was the case. What we see right now is there are a lot of operators that are very highly levered, and that is now becoming more difficult to service. And if you think of machinery costs, they have gone up exponentially. It's over $1 million for a combine these days. And so there are a lot of operators who have very large operations, but also are very heavily debt ridden. And so if they're looking to expand, it can be difficult. And so I believe that the players that are either in a strong capital position or who are wanting to go into the rental model, such as us, are able to access capital providers such as Avenue Living, are going to continue to expand. You just get such efficiencies of scale. There's a reason the US went that way for the large operators. It really does improve the operations, and as we've seen by the demand for food security, that's going to continue. So I think it would probably be further exacerbated in that situation.
And to continue on that, if there are pressures on farmers who are highly levered, does that change the multiple in terms of how you look at properties, or does it change the way in which you're looking at structuring the deals?
Yeah, it would change the way that we structure the deals. I mean, realistically, what we try and do is it is a very commonly accepted metric within the space that 4% yield on your of rent on the farmland is market, and we want to stick to that. We don't want to be that pure capitalist player that comes in and tries to take advantage of any operators that are caught into a position where they can no longer service debt. That may be good for returns in the short term, but if you take this as a long-term play, nobody will want to do business with us anymore. And Saskatchewan is big landmass, small community, especially in the farming space. So we'll continue to put forward that. However, if pricing pricing is favorable, we will push on that, and we want to make sure that we are able to do right by our investors, but also take the long-term approach, because it really is, and it's something we learned at Avenue Living because we started in small towns. If you try and take short-term gains by taking advantage of a situation, it comes back to bite you in long-term operations.
Right. Thank you for that, Gabriel. I don't see there's any other questions. If there are, we will forward them off to you. Thank you very much for your presentation. It was very enlightening.
Perfect. Appreciate it. Thank you for your time, and thank you for everyone listening.
Thank you. Our next speaker is Gavin Trainer, partner and head of sales at New Look Capital. With that, Gavin, I'll turn it over to you for your presentation.
Super. Thanks, everybody. I'll just share my screen here. There we go. Everybody see me okay?
Yes, that looks great. Thank you.
Yeah, so I'll jump in here. So yeah, thank you for that. So I'll give you a little quick background on New Look, and then I'll jump into, I know I got a half an hour here. So I'll jump into the two funds that we offer at New Look is kind of what we made our brand around. So New Look's been around for a little over 8 years now. I'm dating myself. I'm one of the founding partners. There's 3 others here. So I'm the guy basically responsible for raising all the capital, and I'll get through the management as we go here. We have our CEO, Elroy Gust, Bass Osman, who's our CIO, which comes a long track record of managing large private equity family offices, and then Tony Diab, which keeps us in line and makes sure bills get paid and distributions go to our investors. So I'll get started on this theme. I've been in this space now an awful long time, but I really wanted to come up with an offering that was kind of unique. So what we try to do at New Look here is do roll-ups. So buy a plethora of small to medium businesses in a certain thesis or investment style, put them together, all the while giving our investors a return on their investment, and then packaging and possibly selling them off to a larger private equity firm and or selling them off individually, whichever is kind of the greatest value for ourselves and our shareholders. So this fund, we looked at multiple different sectors in the healthcare space, from GP roll-ups, dermatology, nursing, hospitals, high-end cosmetics, and basically looked all over the world at what was trending, what's happened in the space. And what we found out in dentistry specifically is that the US had already rolled up the dental space. Over 30% of all dentists are owned by a consortium, a larger private equity group or an investment firm. The US was kind of the biggest in the space, followed by Australia and the UK, of which it was double digits, where they've been amalgamated and rolled up. When we first started this fund, was coming on some 4.5, 5 years ago, approximately 3% of the 25,000 dentists in Canada were rolled up by private equity firms. So again, not a round peg square hole. We were doing something that was already done. We just wanted to bring that offering into Canada and facilitate it for Canadians. So I'll talk a little bit about why we did this, how we're doing it, and what it looks like from a longevity perspective, what it looks like for an investor investing in a pure dental roll-up. So again, not rocket science here, guys, with this fund. We're buying a large number of dental practices across Canada, not changing a whole lot about them. We're finding something that is of value in a certain area or region, whereby we can keep the lights on, keep it going, but we see where there's some upside to increase revenue and a bit of profitability, all the while servicing a 9% distribution to our investors. So from our aspect, we looked at how do we structure this? What can you do across Canada that can apply? Essentially, none of us can own dental practices, but we can actually own the facilities and the care. We can't infringe on the care of the client. So therefore, our dentist is one of our partners in the fund. So the structure that we offer here is basically a debenture. It's a 9% debenture whereby investors' money comes in. We have an acquisition co that acquires that, and then we redeem the profits from the practices to service the distribution to the debenture. So long story short, it is a debt instrument. It is deemed as income. We give a 9% return annually, distributed quarterly to our investor. And that's what we're doing. We're buying majority ownerships in a large number of dental practices across Canada. So what we've done is we originally went out to, I'll say, date and or find a dentist who had experience in building new, as well as who had failed and actually resurrected, bought something and turned it around and built it. So we found a guy that took us quite a while to find, actually, who was a businessman, not just a dentist. And I'm sure everybody here listening knows a friend who is a dentist, obviously super smart people. And what we liked about the space is that, I'll just use the terminology, dentists eat what they kill. So a large distribution of clients whereby a GP is paid by the government. You basically have one payee. So we thought from a risk mitigation perspective, with again, only 3% of the market being consolidated, we have plenty of room to grow. We can offer this fund at perpetuity, as well as each of our dentists has to perform to be profitable. So we like that as well. What we originally set out to do was kind of buying remote dental practices, small town, Saskatchewan, et cetera, small town Ontario, whereby there's a large retention ratio. You don't have a lot of options to go somewhere else. So what we do at New Look is we try to build a moat around all of our funds, kind of a recurring revenue thesis. So we thought this space, and I challenge all of you listening, try to leave your dental practice without them signing you up for your next cleaning, your next cavity, your kid checkup, or an x-ray. Again, pretty aggressive group. Again, motivated by making the business profitable, which is something that we liked, and diversified against many different clients. So Dr. Sam had done a great job. He was a guest speaker and a surgeon who had gone around and once a week he'd be in one practice doing surgery, and then he rotated day to day to day to day. So over his career, he had seen and met a large number of dentists. He knew the staff in all of them. He knew ones that were successful. He knew ones that could be much better. So we had very good alignment and very good insight into seeing where could we take this and what was our first step. So we always believe at New Look in anything that we do is your operating partner, your management team is everything. Secondary is to look at what am I getting as an investor? What's my return? If the management team's not there, forget it. It's not even worth looking at as far as I'm concerned. So us partnering with Dr. Sam in this gave us some alignment. We first purchased Dr. Sam's 7 practices, of which Dr. Sam turned around and put $3 million of his own money back into the fund at the same rate as our investors and ourselves. And again, New Look put in additional capital into this fund as well to be aligned. It's important to note in a lot of these funds, management take fees. We do in our other funds, but in this dental fund, we didn't take fees. So myself and my 4 partners, from a management perspective, we ran this as a debenture. And essentially, again, when we refinance this or sell this, New Look takes the upside. In the meantime, we've been servicing a 9% distribution over the last 4.5, 5 years since inception in this fund. So that being said, these businesses generate amount of cash flow to easily fill that obligation of 9% to our investors. So what we ended up doing here is a little bit of work on the space, which everybody can see. Dental practices are fairly profitable across the board. The big part of it is hygiene, which a lot of people might not know, or they might know, is the dentist is billable on one side of the business, but the hygiene is a very, very profitable part of the business. So they go hand in hand. So you see the growth, you see the sector, you see the profitability, the number of dental practices in Canada, the annual growth rate projected for these spaces is not going away. So I'll address right now, because I get asked this question almost every day is, yes, but what about COVID? And yes, my answer is yes, nobody can predict a black swan event. Nobody, none of us seen that coming. So from our aspect with everything we do, ultimately, it's always to protect the fund, always protect the NAV of the fund. And I'll give a lot of kudos to my partner, Abbas Osman. He dislikes debt in a very big way. So going into this.
Sorry, Gavin, just to interrupt you. I don't think your slides are moving forward.
I'm moving them on my side.
Oh, okay. I don't know if they're being shared. They're not moving on our side.
Okay, let me look again here. One sec.
Yeah, now they're moving.
Okay, I'll go back to view full screen. Moving now?
No, so right now we're on the slide. It says, what is dental outlook look for when?
Okay, so it's not when I'm on full screen. When I'm on full screen mode, it's not moving. So let's just do this. How about now?
Yeah, now it's moving.
Okay, I'll just keep it like that. Is that okay? Everybody
fine.
can
Yeah,
manage
thank you.
that. You can see my kids' pictures in the background.
No, we can only see your presentation. So you're good.
Okay, no worries, no worries. So I'll go back here for people. I won't rehash this, but people can read while I'm talking. So
Okay, thank you.
again, it was a multi-city roll-up, like we said, rural jurisdictions. Again, Dr. Sam finding the partner to operate this for us was intrinsic in this, and having the alignment where he put his money back in really gave us the comfort to move forward and expand this in a big way. So I'm really just trying to give everybody the understanding is that Canada is a big area that we cover. There's 25,000 dental practices. The largest player in the space went public about 2 years ago, and has about 480, maybe 500 practices that they've rolled up. So that's basically the biggest one that we have. There is a lot of private equity groups now looking at the dental space. So it's nice that we were in it 4.5, 5 years ago. This gives you a little breakdown. I'm sure everybody can see this, the dental fund portfolio that we have. So from an investor perspective, you would like to look at how diversified is New Look, how risk mitigant we are, how is my investment protected? So what we like to say is there's a capital stack that we have on this as a debenture, is that we have the ability in front of the debenture holders to draw up to 25% bank debt, which we currently don't have. We would use that for an acquisition, to pull a big, large acquisition down, possibly. We just have it there just in case. And then the debenture holders, and then myself and my partners, and the $10 million that we've put in, it's like 9.7 million, sorry, is ranked behind the debenture. So, and again, we don't take management fees, but it's important to know the security and where you stack on that debenture. So this gives you a little bit of a, I guess, a geographical look at where our assets are. The patients that we service per year, again, north of 67,000. So that's what I like to reverberate in this, is it's well diversified, our income. The number of dentists now is north of 55 dentists that we have in various different locations. Hygiene is, again, is a big part of our revenue and super profitable part of the business. Hopefully everybody has had their teeth cleaned, and if you haven't, go to your dentist. It helps our fund. Therapists are a big part about what we do here as well, and our operators. So what we like to do in this is find a business whereby, as an example, I'll speak to this, that might be doing, say, 20% of their top line revenue is coming from hygiene. We know we can get that number closer to 30, 35%. So as we look at an acquisition, what we're buying it at, we know we can increase that number. And then we're like, okay, this is a good acquisition target price. We can increase the revenue. We can generate this from the business moving forward. So those are the little areas that our guys have a complete breakdown. And from a valuing a dental perspective, it's super easy. It's not like you're buying, say, a tool and die shop, and then I'm buying a stamping machine shop. Who are your clients? How predictable is revenue? Those are somewhat apples and oranges, whereby in the dentistry space is, what is a crown? What is a cap? What is a filling? What is a cleaning? These are very, very easy things for us to evaluate. The pipeline that we have is enormous. When you think about how many, again, dental practices that are out there, the 25,000, our full M&A team would see around 15 a week that we actually go through. So again, no lack from an investor perspective. There's no lack of dental practices to buy. And what we like to do is create a bit of a cocoon, an area whereby we can have a manager go in and service 5 to 6 practices within an area. And then if we're to expand somewhere else, as an example, if we expand in Alberta, we'd kind of buy a flagship asset and then expand in, say, Calgary as an example, or Red Deer as an example, or Edmonton, and grow it out from there. So that's what we like to do in regards to growing out new footprints, new areas that we migrate into. So again, what we like to look at is recurring revenue and organic growth. So compound annual growth rate for anybody doing due diligence on funds, seeing an 8.8% compound annual growth rate is a great sector to be in. So again, I owe that to our team, and owe it to Abbas and his team, Sean, in regards to buying the right assets for us, as well as increasing those as we go. And I'll give a little bit of just what they've done for us. So each chair, we'll call it, and again, this is it varies kind of province per province, but each chair, depending on how many days a week you're open, et cetera, would generate, let's use 250,000 worth of revenue. So if we can go into a practice and create a little bit more demand or a little bit more profitability, we can add a new chair over time to a facility. So if we can do that through efficiencies in the practice and add a new chair without buying it in the market, that is intrinsically adding, again, another 250,000 to 300,000 revenue for us organically without buying it. So again, our team's done a great job in regards to increasing our margins over the last 5 years in this space. So what does this mean to investors? We are the only pure play roll-up in Canada where you can invest in dentists. That's it. That's basically the pitch. We're the only one in Canada privately giving a distribution If you want to do a pure growth play, you can invest in Dentalcorp. It's publicly traded. We are giving a distribution of 9% on profitable, growing dental practices across Canada. That's it. It's registered in our account, so you can invest in your TFSA or SP, et cetera. The minimum order is $10,000. Again, we're targeting about 120 million. To date, I have raised approximately 95 million. And it's important for guys like us, everybody presenting today, as well as for investors to know. What basically kills guys like us is if you have a large number of cash come in, but can't deploy it. And then you have to service that 9%. So what we learned over time, and we migrated because we've been in the space an awful long time, is my team who's acquiring assets is very important for me to align with how much cash is coming in. So our pipeline is great. We staggered accordingly. So our J curve is not essentially affected. So we have learned over time. So, and I'll address that in our other fund as to what we like to do. It is a 5-year hold. We do a large number of DRIP. Everybody knows what DRIP is. If you don't need the cash today to pay for your son's cell phone bill or your daughter's cell phone bill or university, doing a direct reinvestment is a great way to increase your return over that 5-year period. So again, these are frequently asked questions. I don't really need to read them out loud. I will say that we had during COVID, which we were shut down for, let's say, approximately 2 months with our dental practices. We had never missed a distribution. We had plenty of cash on hand to continue to service that for a long period of time. Again, like I said, it's important to protect the NAV of the fund and just be transparent to our investors through newsletters. What are we doing? What are we acquiring? Where are we acquiring? We like to think we do a great job on that aspect. Just to keep investors aware, I'm a longtime private equity investor. I was a big mining guy, and the last thing I like to see is I put money in and then a year and a half later, I get one newsletter update. So our team tries to communicate as much as we can. But again, Raintree does a super job with their advisors in regards to what are you investing? Where's it going? How is it doing? So a little shout out to Raintree there. Risk factors, everybody knows. You put your money in. We obviously pay fees. So if you want to redeem early, like any mutual fund, like anybody, there are penalties to be paid. Here's our good looking team. So now I mentioned the names, so you can see Elroy, Abbas, Tony, myself. And then additionally, as we've grown over the years, Oliver Bloom is head of our M&A for our industrial services fund and Haas. It's always good to have a lawyer in-house to protect ourselves, the fund, and investors. So that is my pitch on our dental roll-up fund. So now I'll take the time to switch across. Give me 1 second here. A little segue for everybody. Our longstanding, I guess our first fund that we launched with here is my industrial services fund. I'll give a little background on this. So this is how the team basically met up. Again, we got together, as my background's aerospace engineering. Elroy had an idea that he actually owned a bunch of nursing homes, to be honest with you. And then he was constantly getting bills to upgrade our fire suppression, our elevators, and our gas detection. And he had this epiphany where basically, I want to own these service companies. So this stemmed out of an idea some 11 years ago. And we first launched our Industrial Services Fund 1, I think 8.5 years ago. So this is our third iteration. And what this is we buy boring, code-regulated, cash-flowing businesses. That's basically it in a nutshell. So what we like to say is predictable, cash flow, recession resilient, government regulated long-term contracts. So for people listening, you're like, well, what is that? What is that exactly? So HVAC, elevators, gas suppression, wastewater management, grain inspection, weights and measurements. It is a massive, massive space. The elevator space alone, we had a number of elevators that we owned in our first fund, is a $70 billion space. So not small. A lot of people get back to us like, that's such a narrow focus. I'm like, yes, that's the point. I don't want to use your money to go buy a hair salon. We are trying to buy cash flowing regulated businesses whereby you put a device on a wall, you make your margin with that mechanical device, whether it may be. I'm sure everybody's been in underground parking or been to the mall. You're sitting there in the winter, your car's running for 30 minutes. Thank God there's a gas detection system on the wall to turn on the HVAC to bring in fresh air. So these are all things that might go unnoticed, but are extremely regulated from a federal perspective, provincial perspective, by city ordinance as well. So what we've done is buy a large number of those over time. And from those cash flowing predictable businesses, we serviced an 8% preferred distribution to our investors, distributed quarterly. These are just, I'm going to walk through a little bit of the areas that we have: the Clean Act Water, occupational health and safety. I'm sure everybody's been on an elevator and seen the TSSA up there. Maybe somebody knows an HVAC guy, a plumbing guy, electrical guy, an elevator guy. This is a bit of a side note, actually, for those of you who might be listening who have kids who are 17 or 18 or 19 and don't know what they want to do. Elevator mechanics have a great living. In the US, make about $220,000 a year, and in Canada, anywhere from $140,000 to $180,000 a year. So again, I'm a huge promoter of trades, and we're lacking them in this world. It's a great discipline. They get paid well, and we need more of them. So tell that to your teenager. This is a little bit of a management track record, just a little bit of a breakdown of where we have these assets and what they represent. So we did a bit of a fire roll-up cell phone tower that we're trying to kind of put together, again, create a little bit more intrinsic value, roll them up and sell them to a larger private equity group, but also mitigate the risk of the fund, what we have here. So I'll talk about IFSS. You see it just down in the tip of Florida there. It is a great company, actually, that we bought. So what it does is it builds and controls and monitors fire suppression technology. So some people might live in a condo. You'll see the big blinking lights when you walk in and a kind of a fire control panel. That's regulated and monitored 24 hours a day, of which software regulates that, and that communicates with fire departments, et cetera, et cetera, et cetera. So what we have in the US for these as well, which is unfortunate but fortunate, is if there is a shooter facility or someone comes in, we need to be able to directly contact, open doors, close doors, and mitigate what could possibly go wrong. So that business has completely done super well for us as municipalities and government buildings need this software put into place. So we're on RFP lists, we're approved in the state of Florida, and we have a large, even during COVID, there was large facilities that we could go into, and the backlog of orders that we had fulfill those obligations. That's one aspect that we do. I'm going to talk about Insight. I'm not going to talk about all these, just so everybody's aware. Insight Engineering, you see just to the left there, is in Alabama. So what this group does, it's an engineering firm that designs in a rural town an entire waste management facility. So everybody flushes the toilet during COVID. There was kind of no way around it. What we did is design, implement, and maintain a 40-year maintenance contract. So this is the moat that I talked about earlier in our dental fund. The moat that we have here is we put on a device, which we make our margins on, and then by law, we are mandated to service that, whether it be on a monthly, semi-annually, or annual basis. That's where we make a lot of our profit on, is the maintenance side of this on an ongoing. So the more devices to have, the more maintenance contracts that we have, which for you and ourselves, when we go to sell as the alignment, there's a lot of money, possibly increase in value, to be paid for those contracts. So the fact that we have a 40-year maintenance contract for our wastewater management just adds a little bit more level of predictability, recurring revenue, which I'll talk to you about this, which is basically all that we want. And from our aspect, the more recurring revenue we have, we're mitigating the risk on the fund moving forward. So you'll see Fund 1 here that we have, that we started out. We went out to originally raise, it was our first launch fund. 40 million was kind of my target. Ourselves, friends and family, put in approximately 14 million of the 44 million. So again, that's important to reverberate to potential investors and existing investors as to how aligned New Look and our team is in moving forward in that. So that fund grew. You'll see right there, recurring revenue is approximately 20 million top line revenue. So again, those are from those contracts that I discussed. So that was, again, a 5-year fund that we had in a mutual fund trust, whereby you can invest a minimum of $10,000, 5-year registered account, your RIF, your TFSA, et cetera, et cetera. Fund 2, we did the same thesis, but what we decided to do with Fund 2 was expand into North America. Fund 1 was just Canadian focused. We decided to expand into North America. We were seeing some pretty good multiples in the US, where we could buy at a lower valuation and possibly have bigger synergies, which is where that kind of stemmed from. So I went out and raised, again, approximately, let's say 60 million. Again, the recurring revenue part of that is 44 million. So we like to think what we've gone is bought those, extend the contracts. We gave kind of promotions, whether it be a device you install. And you got to think some of the big buyers for these that we have with gas detections would be the REITs that operate across Canada and the US, whereby you deal with, say, Dream REIT or something else where you go the property manager, be like, I can do your gas detection, I can do your fire suppression, and I can do your elevators. Here's a bit of a discount. We'll take over it all. So that's kind of the synergies that we're trying to bring to the space moving forward with this fund. So management track record, here we have Fund 2, Fund 3 recurring revenue combined. It's pretty basic what we have here. Again, we're trying to build the recurring revenue to, again, stabilize the companies moving forward and stabilize the distributions to our investors. Again, we have the ability to have debt in each of these instances. And it's kind of at our discretion per company as to what we use. So again, during COVID, Abass was always from day one kind of debt averse. So when COVID did strike, we canceled an acquisition that we we're going to do. So we had cash on hand, as well as we had lines of credit already lined up from a previous existence that we had the ability to draw from. So did not miss a distribution, continue to make our distributions and manage the companies moving forward. The fund evolution. So it's important here, like we have a great relationship with Raintree and we do listen to investors. We originally set out with Fund 1 with certain parameters. We had, and I'm not going to read all these to you guys, but we'd been asked to give a little bit US dollar exposure and US company exposure. So Fund 2, we went out and again, okay, we listened, we made changes, and therefore we'll start acquiring companies in the US. It's a somewhat of a 50-50 split, depending the sector in what we have in Canada and the US. And then Fund 3, we went out and kind of revamped the whole fund, again, targeting an 8% distribution to investors, but we created a different split that if it's going to be an evergreen fund and it's a 95-5 split, so as we make and or sell an asset, the profits get split 95% to the investor, 5% to New Look. So we're evolving as we go. We are listening and trying to make changes as to what our clients want. Here's the investment highlights that I can briefly, I don't need to read them to you guys, but again, this one we do take a management fee on, and the targeted quarterly distribution is again 8% per annum distributed quarterly. So you get your 2% distribution. This is again eligible across the board and eligible in US dollars as well. Yeah, I can discuss certain sectors. It's funny. It's like when you buy a white Jeep, you drive down the road and all of a sudden you see thousands of white Jeeps. So when you're in my space, you see fire suppression, wastewater management, non-destructive testing. The sectors get bigger and bigger. Pest control is a huge space. Elevator maintenance, gas detection. So again, I like to reverberate that if elevator service is 70 billion, gas is 30 billion, we have plenty of companies to buy moving forward. Again, we like to be that we're invested and put in our money to be aligned with everybody. So as you create a new fund, we additionally as partners put in additional capital. I've always striven since day one. So my families are teachers. I come from a very small town of less than 1,000 people. And being in banking this long, I always had a pet peeve that why don't we see the really good deals? And Raintree has done a phenomenal job in bringing private companies to the investor. This is not a shot. This is not anything. I like to educate people that if you go to TD or any bank and ask to invest in New Look, it's going to be tough. So thank you, Raintree, for creating this opportunity for all of us, for investors and ourselves. But my goal is now and moving forward to bring those types of institutional investments to the retail Canadian. Just opening up everybody's eyes that these are good investments. They do exist. Dare you to call TD and ask for them or RBC. It's a bit of a challenge. I'll leave it at that. Forward-looking statement for myself. That's what New Looks tries to bring to everybody. So those are the two funds that we offer: dental roll-up, and we'll call it industrial services roll-up in North America. That's it.
Great. That was a great presentation, Gavin. Thank you very much. We've got a couple of questions specifically regarding your dental fund.
Sure.
The first question was, you mentioned therapists or dental therapists. Can you explain who they are, or that was misquoted?
Yeah, sometimes specialists come in that we have and therapists comes in, depending on the province that we have. Come into, and it's just an extra billable. It's a small sector of our business, but it's important for us to have them. It's an extra service that we offer. In that side as well that we cover is, has anybody got braces for their kids? I can't see anybody's hands, but I'm assuming everybody or a large number do. Invisalign, which everybody might be familiar with, which was normally done by an orthodontist, is also coming into the dental sector. So let's just say an arbitrary number, you would do $5,000 for hard braces. Invisalign is basically a scan where you put a plastic mold, like anybody plays hockey, you get a plastic mold, you put a different one in every week and it slowly changes your teeth. So therapists are also in that sector that help us do that as well. So it's a big part of our business. We are stealing good business from orthodontists, and most of our guys are regulated in that space.
Thank you. Our next question, I think our last question, is on the dental fund.
Yeah.
Are there changes still upfront? So the question was, is it equity to debt versus just debt?
Yeah, listen, so again, this is me listening to advisors and what people really want. When we built this, it was an overwhelming we can't do equity. So guys, the thing here was, when we first built this, you can't own a dental practice. You can't, it's illegal. You can't service and or influence the care of the client. So from a College of Dentistry, only Dr. Sam can own that client list. So how all of us in this space, not get around, but how we manage that is Dr. Sam manages the care of the client. New Look owns the rest of it. The lights, the fixtures, the staff, the consumables, all of that. So what we originally did is we listened to the advisors and we said, everybody wanted a 9% distribution with no upside. So that's what I built. Now everybody, fast forward 4.5 years, is like, Gavin, you did such a good job. Why couldn't we have got equity? So it's kind of like arguing with your kids. You can never win. But currently the answer is it's only a 9%, which is still a great return that we give. There's no upside.
Okay. Well, thank you very much. There are no more questions. So Gavin, thank you very much for your presentation. It was very well received.
Thank you, everybody. Have a great day.
Thank you. We're going to take a short break right now. We'll reconvene at 12:15 Mountain Time, 2:15 Eastern Standard Time prompts. Thank you. Welcome back, everyone. I hope you had a good break. We'll be proceeding again with the next round of our conference, our investor conference. These presentations will be a bit shorter and they'll be kind of in rapid fire. So we'll ask that you hold off your questions or direct your questions directly to your private wealth advisor. With that, we'll introduce our next speaker, Danny Friedman, owner and vice president of corporate development at MakeSpace. Danny, over to you.
Thanks, Jay. And thanks for Aintree for putting on this event, and thanks to all the other presenters as well, and funds that are available alongside of us, and all great offerings, and appreciate everybody's time spending with me. I'm going to talk about self-storage here and talk about MakeSpace Capital Partners. Again, we only have 10 minutes. I can't cover everything. I do encourage you to talk to your advisor. We're in a very unique situation right now for investment, and I'll go through that. We're sort of at the sunset of our raise here. We've built a portfolio of stabilized storage investments. We now have 18 storages in our portfolio. We're closing the investment into our fund in the next month. So March is actually the last close for our mutual fund trust. We have over 40. Our goal at the beginning in 2019 was to raise $30 million. We've raised over $40 million. We have over 700 investors and over 18 assets and over 1 million square feet of storage in our fund. And this is an opportunity to get in there and enjoy the last 3 years of growth and the opportunity to divest as a portfolio. So that said, I'll talk first just about storage. It's such a great opportunity, storage, and it's been such a great sector for investment. And just talking about the demands, like so storage in Canada has about 3 square feet per capita available. to Canadians. In the US, it's about 9 square feet per capita, so there's lots more supply. The demand in Canada is incredible, and what drives the demand further is the amazing population growth we've been having. I think we welcomed about 450,000 people to Canada last year. We expect to welcome another 1.5 million people. It's a lot for our cities and towns around the cities that have been bursting at the seams, and we've seen that in our housing. And what happens is housing prices go up. The places get smaller, but people still want the stuff. They come to Canada to have a good lifestyle, and they gather stuff, and they need a place to put it. And storage has become a very viable option for them to put stuff into sort of permanent storage, for their skis or their artwork or the stuff for the next generation. And that demand, especially with the cost of building new storages going up so much, the supply has not kept up with the demand. And so we anticipate that the demand will only grow. And really over the last 30 years, there has not been a bad time to invest in storage. And this chart sort of shows it from 1994 to 2017, and it's continued over the last 3 years. Not only has storage returned more to investors than any other REIT class, but it's also had the lowest volatility. And we've seen that in the 2008 recession or money crisis. We've seen it in 2020 during the pandemic. Self-storage just maintains its occupancies and maintains its returns. There's just different demands at different times in different markets. So what's our plan for storage? So there's lots of ways to get into storage. You can find a piece of land in your local community, build a storage. You can invest publicly in the public markets. They have big portfolios of storage that you can invest in, pay a higher price of a lower cap rate. And our plan is simple. We built a diverse group of storages across the country, so you don't have single market risk. And the idea is, let's buy some mom and pop storages and put them together, build a portfolio and sell it off at the end. And so that's what we've done. We have a stabilized portfolio. It does kick off a 6% annual yield to investors. That's paid quarterly, 6% annual yield paid quarterly. And then in the end, we believe we've built a quality portfolio that fetches more return than the sum of its parts. And our business plan, and I'll go through this in just a minute, instead of buying the land and then just sort of putting shovels in the ground, building the building and slowly leasing up and then getting into profit, we've been buying storages here at stabilization. And then we build the revenues from there and add on our portable fleets and other ancillary revenues that really take the top off of the growth. I'm just going to go into a couple examples there of the growth that we've been able to achieve. But first, let's talk about our roadmap. So we started in 2019, we had 2 assets. And about $5 million in equity that we put into the fund, and $10 million of assets under management. In 2020, we raised enough money to buy assets in Prince George, which I'll talk about the growth of that. Actually, I don't have it in this because we're so condensed, but we grew Prince George from a value in 2020 of $14 million to over $20 million in value now. In 2021, we really laid the groundwork for more storages. And in 2022, last year, we bought over $86 million of storage across the country. So starting at $10 million in 2019 to over 140 million in assets under management in 2022. And from here, we expect to just continue to grow the assets under management. We don't believe there's the same opportunity now to meet sellers' demands. The price of storages has gotten so high that we're not willing to commit more investor capital to chase that storage dream anymore. We believe that there may be some assets where owners may age out, and we'll pick those off and put them in our portfolio. But for the most part, our goal is to grow our portfolio from here, make a nice tidy portfolio that's aligned, and then exit it as a group in 3 years from now. Here's a look at our portfolio, all the way from Pender Harbour, BC, which is near Vancouver. We have in Port Coquitlam, Prince George, several assets in BC. 3 or 4 in Alberta, a few in Saskatchewan, 1 in Manitoba, and then a few in Ontario. And you can see we don't build the sort of, I call them the Taj Mahal storage center city, investment in a big building storage with the really high rents. We're building these nice, tidy, money-making storages in communities across the country. So just talking about some of the growth that we've been able to achieve. Pender Harbor, we bought, that was one of the initial assets, came in at about $5 million. In 2 years ago, it was appraised at $6.2 million. If we look at current fair market value, it's sitting around almost $10 million. In Winnipeg, we had this appraised last year. Winnipeg came in at $5.25 million, now up to $7.5 million in value. Prince George, like I said, we invested at 14.35. Last appraisal was at 20.7 million. If we look at Prince George according to the NOI this year, or our EBITDA, and appraised again, or sorry, valued against the same cap rate that it was appraised at, we'd be sitting closer to $24 million in value now. And the rest of these assets have been bought within the last couple of years. So it's time to put MakeSpace's magic touch towards those and let our in-house management team really grow those investments. So what's the exit options? We saw this at the beginning. I haven't changed this slide in 3 years because it's the same opportunity. But now our first focus was to build a portfolio, and now we're growing those assets and then selling them. And this is going towards our exit. So what are our opportunities? We could sell to a larger storage operator. Those types of sales have gone on in Canada. There are currently no portfolios this size available in Canada. And we don't expect a lot of the people who are building portfolios, there's not many, there's like a handful of them. We don't expect any of them are going for sale anytime soon. They're sort of long-term buy and hold storages. So for a company, as an example, like Storage Vault, which you can look up online, you know, they built a public portfolio of storages or storage REIT. You know, for them to take us out would be exceptional purchase for them, because they get one buyer of $150 million instead of going to 7 or 8 different vendors. Institutional investors, 150 million, 200 million. That's a nice bite size for them to invest in. They can't buy the $10 million storage. Sale to a larger MakeSpace fund, like it's possible that we go into an evergreen fund and we continue to grow and give people opportunity for liquidity, but also the opportunity to continue to invest in storage with us. And I'm running out of time, so I want to make sure I honor the time. Again, 6% yield. Our last close is this month. So if you do want to look at MakeSpace and you do want to look at storage in this option, talk to your advisor, and they'll be able to answer questions. They've been working with us for 3 years, and they know all about MakeSpace and what we can do. And that's it. Thank you very much.
Thank you, Danny. It was a great presentation. Our next presenter is Scott Lee, Principal at Revesco Properties. Scott, over to you.
Hey everyone, sorry, I'll get my screen on here.
Yep.
There we go. I'm going to share screen. Is that working there?
Yeah, that worked.
Okay, there we go. Hey, I want to thank Jay, Peter, and the entire team at Raintree for putting on this presentation and giving sponsors like Revesco an opportunity to discuss the platforms. I'm Scott Lee. I'm one of the founders of Revesco, and I'm going to talk about what is Revesco Properties Trust, who are we, why retail, and finally, I'll dive into how we generate returns for our investors. So we formed RPT just about over a year ago as an open-ended mutual fund trust that invests in the US. So what does that mean for Canadian investors? It means they don't have to file a US tax return. We buy open air retail centers and mixed use retail projects. So this means we're buying great quality retail centers anchored by either grocery stores or other large format retailers, and mixed use projects with retail on the ground floor and maybe a little residential or office above. But the one thing we're not buying closed malls. The fund's US dollar denominated. It has 100 million in assets under management and roughly just under 50 million of equity today. And because my partners and I are Canadian, we tend to be very conservative by nature. So we only use about 55% leverage on any acquisition. What that really means is that me and my partners probably have personal guarantees on almost all the mortgages. So we pay very close attention to every asset that we own. Also, we do not use any variable rate debt, which I think is something that a lot of other REITs have probably used in the past, and it's obviously come back to really hurt them in today. And now the stuff that really matters, RPT pays out a 6% annual distribution every quarter with a targeted annual return of between 10 and 14%. And we never missed a distribution, and our NAV continues to grow. And finally, our money is right beside your investors' money, as we co-invest 10% of all the equity required, up to $5 million US. So I'll just dive in terms of who Revesco is. Reese, Chris, and myself all knew each other from our university days at UBC and SFU. In the early 90s, Reese worked for a major property owner and developer in Vancouver, but ultimately his career took him to Denver, and that's where he had his development career there. And he was doing something similar to what most national development firms would do. They would buy large tracts of land, get them rezoned, entitle them for a new residential community, sell off the lots, but he always kept the commercial and developed shopping centers. Chris and I, we went down a slightly different path. We started a business in 1996 called Northwest Atlantic, which is a commercial real estate firm, which handled all the real estate strategies for US and international retailers like Apple, Walmart, Target, HomeSense, Winners, and on and on and on. This gave Chris and myself direct access to every major retailer, both north and south of the border. We grew that company into the largest tenant representation firm in Canada, with about 50 employees in 3 different offices. And then in 2018, we exited out of that company to JLL. Since 1996, we've always invested every excess dollar we've ever generated from our operating companies into real estate. So we've been sponsors of several GP LP structures throughout our entire career. So it just made sense for us to form Revesco about 11 years ago. But as our track record grew, our existing investors wanted a permanent investment vehicle, which led us to the formation of RPT. But as you know, you can't do it alone, and we certainly have a good team around us. We have Mark Miles here, our CFO, based in Denver, with Adam here in Calgary, and then most recently, we have Julianne Booker join us in Vancouver from Western Wealth Advisors. With Reese living in Denver and with his expertise in development, combined with our extensive background in retail, we decided to locate the company in Denver. We built our own office building. We've hired specialists in every aspect of the business. So, for our RPT, we feel it's absolutely critical that we have boots on the ground, because I would not want to invest in the United States without having a local presence. And we also believe that's another reason why RPT is a qualified sponsor. So why retail? Well, for us, retail plays to our competitive strength. We know this industry really well. We know every major player in the industry. We know what to look for. More importantly, we know what to avoid. Multifamily and industrial sectors have been the darlings of real estate for a really, really long time. But as a consequence, most of the equity is poured into those markets and has made retail a far better option or far more attractive for returns going forward. Look, everybody still needs groceries and clothes and services. So the retail demand remains relatively constant. But the supply of new retail relative to population growth is actually falling. And it's because very few developers can afford to build new retail. Just try getting a contractor to show up at your house. Obsolete retail centers are being redeveloped or taken out of the marketplace every day. And that just helps reduce the supply of new retail. The other part of the retail industry is that it's highly fragmented in the United States. They don't have 3 or 4 massive REITs that own all of the shopping centers like they do in Canada. So it creates great opportunities for qualified sponsors like RPT. And finally, COVID has certainly accelerated the online sales growth. But at the end of the day, online sales at their peak only reached about 16 or 17% of all sales in the US. So the majority of sales are still happening in physical stores. Even today, online retailing and the Amazon effect have kind of leveled out at about 14 or 15% of all retail sales. So strategic relationships. This is one of our key advantages. Because of our 30 years of experience in the marketplace and working with US-based retailers, we've got access to information and people that, quite honestly, other sponsors just don't have access to. Our relationship allows us to get the real story on store performance and helps us underwrite these investments accurately as possible. Now, how do you buy right? I think in addition to all of these factors here on the slide, we start getting really interested in shopping centers when they're located in trade areas or markets that have household income growth, wage growth, and population growth. Those are the kind of factors we look for as we continue to look into various target markets. Now, where do we find these markets? Well, the two main reasons why RPT focuses on the US is that the returns for retail in Canada are lower than the US because of the amount of institutional money here in Canada that's chasing so few opportunities. It just drives down the returns here. Quite simply, there are just more opportunities, more trade areas, and more lenders in the US. You know, for example, in Canada, there's only 6 major banks and approximately 35 Schedule I financial institutions, while in the US, there's over 5,200 different lenders that we work with. Also, having an entire operational team in Denver allows us to access any of these markets within a day, as Denver is a major hub for United Airlines. So how do we increase value for our investors? In all of our centers, every single lease has a pre-negotiated rent increase as a hedge against inflation. And this means that our NOI is increasing every year. So if you take a look at the formula below on the slide, it's just kind of a basic formula for how real estate's valued. So in Canada, when buyers acquire a shopping center, they have to pay full value for the vacant space. But when we acquire a shopping center in the US, the vacant space comes for free. So for example, if we acquire a center that has a vacant unit of 5,000 square feet, and we're able to lease it at $25 per square foot, we can generate an additional $125,000 of additional income, which means we just created over $2 million in additional value for that asset at a 6% cap rate. So just to wrap up and talk and summary of, excuse me here. There we go. Our fun facts and just a summary of our metrics. Again, the 6% preferred distribution. We target an annual rate of return of 10 to 14%. And again, we co-invest 10% of every acquisition along with our investors. So why RPT? You know, at the end of the day, physical stores aren't going anywhere.
Sorry, Scott, you've got 15 seconds left. We've got a tight schedule left.
All right, well, great. And I'll just close up by finally, we're qualified sponsors with a lot of experience. Thanks very much.
Thank you, Scott. Sorry about that. We've got a tight schedule. I'd like to next invite Jamaica Sarchekov, Director of Sales West at Invico Capital Corp, on her presentation. Jamaica, over to you.
Perfect, thank you. All right, perfect. I'm going to quickly share my screen as well. So yeah, just again, let me know when you can see everything.
Yeah, we can see your Diversified Income Funds presentation.
Perfect. All right. Thank you, Jay. Thanks for having me today. I am here to talk about our award-winning Invico Diversified Income Fund. Before I jump into it, though, I do have to go through a couple of quick disclaimers. Again, before making any investments, please sit down with your DR to make sure that this investment is suitable for you. As well, there may be some forward-looking statements throughout this presentation. And before making any purchases, again, know your investor rights and go through the OM in its entirety. And as with all investments, there are some risks associated with this fund. So The Invico Diversified Income Fund is essentially a private debt fund focused on generating monthly income through a diversified portfolio of high yield lending strategies with real assets. If I'm breaking it down in one sentence, we're a private debt fund with an energy kicker. And I'm going to get into that in a little more detail as to why I call it that. But let's start with some of the top-down information on the fund. So we are actually sitting at over 425 million in AUM. We target around a 7% a year, paid out monthly, plus the option to have additional distributions on a quarterly basis if earned. The fund has been around for over 9 years, and I am very proud to say that since inception, we have never missed a single monthly distribution, and that's including throughout the pandemic. We are available for all accredited and eligible investors, and it is available for all registered accounts. So some of the key highlights that we saw come out of Q3 is having that energy kicker or energy exposure to real assets and commodities really provided a natural hedge against inflation. And I'm happy to say that we did announce additional distributions for Q1, 2, and 3 of last year. And we're just waiting to complete the audit to see if there will be an additional distribution declared for Q4 as well. But the energy exposure was really what drove the additional distribution payments for those first 3 quarters of the year. So again, we're targeting around a 7% a year paid out monthly, plus the potential for this additional distribution. And as you can see, our performance numbers, our 1-year number at the end of Q3 was at 13%. So the fund was having a fantastic year. And since inception, the return number is 12.9. So Invico Capital Corporation has actually been around for 17 years now. We're sitting at just over 2 billion in AUM, all deployed in the private capital markets. We are not only registered portfolio managers, but we are registered IFM or investment fund managers. This is important to you as investors because it means that we're held to a higher set of regulations and standards. So again, it's just another set of checks and balances. We are IFM to 5 funds total, including our signature, the Invico Diversified Income Fund. We're sitting at around 50 employees at the moment. And again, as I mentioned, I'm very happy to say that in our 9-year track record of this fund, we've never missed a single distribution or redemption request. As well, ESG is something that's very important to us, not only from an investment standpoint, but as a corporation, it comes all the way top down. We actually received our PRI signatory back in 2021, which means that we adhere to the UN's 6 principles of responsible investing. The portfolio managers that we have on this fund are extremely experienced. Allison Taylor, she's our CEO and one of our co-founders, and she's actually received many awards over the years. Most notably, she won one of WXN's Most Influential Women in Canada. We're very proud of her there. And in 2019, she won Female Executive of the Year at the Wealth Management Awards. And then most recently, both Jason and Allison, our co-founders and PMs, won one of Haskell's Excellence Awards. And it's one of the highest honors that they give out at the Haskell School of Business. So we were very excited when they received that award in November of last year. Allison also sits actually on the investment committee for the University of Calgary, and she advises on all of their alternative investments. And she also sits on the Exempt Market Dealer Advisory Committee. So she is seen as an expert in industry. Jason Brooks, our other portfolio manager and co-founder here at Invico, has personally advised on over 3 billion in M&A transactions in both the public and private markets. And then we also have a third portfolio manager on the fund, Chris Watsky. He's our CIO. He's got over 30 years experience. We brought Chris on last year as our third portfolio manager. He was always our CIO and head of the investment team, but we wanted to bring him on officially as a third portfolio manager because we thought it would be good to have a portfolio manager on the fund that does not have an equity stake in Invico. So again, it's kind of another one of those checks and balances that are in place. On top of the 3 portfolio managers, we actually have a full investment team of 10 individuals that oversee this portfolio. They meet on a weekly basis, and every single deal that goes into the fund goes through this committee of 10 individuals. If one person on the investment team does not like a deal, for whatever reason, it does not go into the fund. So again, it's a really nice set of checks and balances that we have in place for you as investors. Now here's our target asset allocation, and again, why I call this a private debt fund with an energy kicker. And it's because you typically see anywhere from 50 to 60% of our portfolio in our lending strategies, and then anywhere from 30 to 50% in non-op energy working interest and royalty positions. So that's that energy kicker I was talking about. And then you can see anywhere from 0 to 25% in our equity yield. And we always have a portion of the portfolio sitting in cash to meet any of our redemption obligations. So as the lending strategies are really the bulk of our portfolio, I thought I'd dive a little deeper into this. We look at loans anywhere from 3 to 30 million. We will never enter into a single deal that is more than 10% of the fund's AUM. So that's kind of why you see that cap out at $30 million. These typically tend to be short-term corporate bridge loans. So our terms range anywhere from 60 days to 3 years. And the interest rates that we charge are 10% plus. So as I mentioned, the bulk of this really is or does fall into this corporate bridge lending position. And so we'll have companies come to us, for example, if they need to take out a competitor. Maybe they just won a really large contract and they need a quick influx of cash to be able to buy raw supplies or add more manpower. And they just don't have time for the banks or traditional lenders to turn around a loan. Banks can take anywhere from 8 to 18 months to turn around a loan. We could turn around a loan in 2 weeks if we had to. So that is why we're able to charge higher interest rate a lot of the time, because we're able to get these companies the money they need right away. And then it's very typical for us to be taken out by a traditional lender, 12 to 18 months down the line. When we're looking at this space, we also look at mortgages. We do have film financing, which is a really fun and unique thing that we also do. And again, when it comes to lending, we typically are in first position for most of our loans. The only time we will take a second position is in real estate. The other large portion of our portfolio falls in that non-op energy working interest or royalty positions. We'd like this one, like I said, this exposure to commodities acts as a natural hedge against inflation. The way that we play oil and gas is extremely unique and very diversified. We have we get our investors what we call wellhead economics. So we have extremely low overhead. We essentially own the land and mineral rights. And when a large operator comes to drill on our land, we pay our portion of the cost and receive our portion of the revenue. So we typically, let's say a well costs around $5 million to drill, and we have a 3% stake, let's say. Just to participate, it would cost us only $150K. We tend to see our money back in anywhere from 12 to 18 months, so very similar to our corporate bridge loans. However, these wells continue to produce for 5, 10, 15 years, and that's just free cash flow coming back into the fund. So for us, who distributes monthly distributions to our unit holders, we really think having exposure to this asset de-risks us from a cash flow perspective. I am going to jump just because I know we're running short on time. This is what the portfolio looked like at the end of Q3. So again, we had 23 lending arrangements. The average size was about 6.5 million. The average term to maturity was 1.9 years, and the average interest rate was 13.3%. Our energy working interest side of the portfolio was sitting at 40%, so right on target. And we had interest in over 2,000 producing wells across both Canada and the US. I can tell you that we are more gas weighted when it comes to Canada. I believe we're over 75% gas weighted in Canada and around 65% oil weighted in the US. Here's our track record. A couple things I like to just point out here. Not only are we an award-winning fund, you can see we placed at the Canadian Hedge Fund Awards in the past, and actually in November, we won 3 awards. We got first place in the 1-year return, second place in the 3-year return, and second place in the 5-year return. And that's just, again, goes to show our consistency and track record over the years.
Sorry, Jamaica, you've got about 20 seconds left.
Perfect. Okay, just to wrap it up, again, why would you add IDIF to your portfolio? It's really our management team's track record. We have over 9 years track record with this fund. The commodity exposure that we have is a natural hedge against inflation. As well, something that makes us unique is we're able to get some tax efficiency on our monthly distributions. As the way the company is set up, we are able to get a portion of our distributions taxed as ROC for tax purposes.
Great. Thank you very much, Jamaica, for that speeding up for us. I appreciate it. Great presentation. Our next presenter is Brian Koning, Investor Relations at Westbow Capital. Brian, I will turn it over to you. You got 10 minutes.
All right. Thanks very much, Jay. Just share my screen and jump right in. Okay. Everybody can see that now?
Yeah, that works. Thank you.
All right, fantastic. Thanks so much. All right. So good afternoon. My name is Brian Koning, Investor Relations from Westbow Capital. And yeah, just thanks Raintree for giving us the opportunity to share with your investor group. And to that point, this is just recognizing that this group of people on this presentation are people that have long-term goals for their portfolio and diversification. And those goals have a lot to do with the legacy that they're trying to leave in their life. We talk about partnership, stewardship, legacy as a bit of a thread through our Westbow Capital vision. And we are here to help. So whatever that legacy that you wish to leave may be. So just getting to the regulatory requirements, of course, as everybody knows, the OM requirements require all investors to do their due diligence, an aspect of risk factors. So we just acknowledge that. And let's just jump into the Westbow story. And so who is Westbow? Westbow as a group of companies. We have 750 million assets under management, 250 plus employees now. Westbow is a group of companies of which Westbow Capital is part of. Westbow as a group has existed since 1977, starting with interest in construction and building homes, and then moving into development and interest in agriculture, dairy, poultry, heavy equipment division, ProKey, property management for our residential real estate fund, as well as a Westbow Gives Back initiative. We have an area of impact that we've chosen to make in the developing world around building schools where needs exist. So that's a little bit about Westbow Capital. Dick Westring is the founder since 1977, somebody that I've known personally for 30 years as a man of integrity. His now son is now CEO, Nick Westring, has now taken the helm and is continuing to represent that long, strong history of this family-owned business. So that's a little bit about Westbow. Now, what are we offering? Westbow is offering participation in a real estate portfolio of both stabilized value-add residential rentals, as well as purpose-built rentals built by Westbow Construction. So that's the little short summary. And what is the advantage of a real estate fund? There's a number of tax-efficient advantages when you get into the areas of investing through TFSA or RSP, or on a bigger picture, you could use your holdco to invest to take advantage of corporate tax rates. So there's some tax efficiencies to be found. The fund is managed very professionally. It's a great management team, including the Westrings and a team that surrounds them, that now managing over 1,100 doors in this pooled investment. And the advantage of pooled investment is, rather than just being an individual investor looking to invest and take on a few individual acquisitions and take advantage of rental income, you now have the advantage of investment spread over many sectors and managed for you, taking away the headache of actually managing. In diversification, we're spread across Western Canada in multiple markets, so certainly have been strategic around that to mitigate risk and remove our exposure to only one market. Now, on the whole, across Canada, why residential rentals? That is the structure of this fund, and a lot of it has to do with what we're seeing in the country right now. An interesting statistic of just recent announcement is in the first 3 quarters of 2022, 776,000 people added to our population in Canada. It's the fastest population growth since Confederation, since our country was founded. So so things are looking up in the future in the aspect of the need and the necessary requirement for housing and residential real estate sector. Including in that stat is the 500,000 target per year of new immigrants to be added to the country. That is a federal government target that is not quite there yet. It's already quite sizably approaching that. But by 2025, their target is to add 500,000 new immigrants to our country each year. All of that combined is showing where we're tracking right now is 3.5 million in shortage of forecast housing need by 2030. So there's just some significant levers that are showing how this sector will remain very strong. So on that point too, multifamily facts, just tracking statistics there. Rental rates have continued to increase year over year, showing since 2006 here. Also, vacancy rates remain very low, and the strong performance even through the recession shows good forecast to be in this sector. So our strategies, how do we play in this sector? You might call this the WESPO way. So we have a design build strategy in the aspect of WESPO construction as part of our group. So we own the dirt, we have the product, we have the expertise. And so we add product to our residential rental portfolio that we've purpose built for that reason. We can obviously acquire it under market value, which brings a lift to the value of the investment fund. The renovate and reposition approach has a lot to do with just looking for product that has potential to add value to by doing some light to medium renovations, and also reposition in the aspect of how rents currently are showing, how the building is operated, and look for efficiencies there, and then raise rents to market value and bring more value to the portfolio. Same with reposition and refinance. That's maybe a product that's not so much needing renovation or anything extensive, but just repositioning to make sure it's at market value, and then looking for a refinance valuation from CMHC to bring more value to the fund. And new acquisitions are products that could be performing well already, and our due diligence has shown that this is in an area for long-term growth and strength. So we'll acquire and bring some of those into the fund. So it's definitely a blended approach, you would say, is the WESPO way. And all of that to say we would look at perhaps 100 properties initially in our due diligence to dial it down to 10, and then to zero in on 1 or 2 to make the right selection to find something that's going to perform well and bring value to our investors. So quick examples of that are 46 units here in Saskatchewan. These were an example of something that was built by WESPO, purchased below market value, bringing stable cash flow. Renovate and reposition example, here's an older unit that was purchased a few years ago. And one of the significant lifts there was just the fact that it was below market value, and we brought the rents up on all units up to even 320 in some cases. There's future opportunity to add more value with some renovations that are upcoming. And then reposition, this one really didn't need the renovation, but needed to have rents increased, and was allowed us to do a CMHC valuation after 8 months. It resulted in a 3 million higher valuation just in that short window of time. So everything is done very strategically in order to look for value in the long-term growth and performance of the fund. And those return drivers are all of these levers that you would already understand. Pretty simple equation: asset appreciates and debt gets reduced, and all of that just results in the equity growth and cash flow that is possible in a residential rental environment. So what are the projected returns then to participate in this residential rental fund? There's 9 to 12 targeted annual returns. There's also the opportunity, if you wish to, you can take out 60 cents per unit or 6% on a monthly basis. So some investors are looking for more of that income fund, and they take that out month over month, and others are looking just to leave it in and just continue to reinvest to grow the asset, and they're having a more of a long-term window. The 9 to 12 window is the targeted annual return as a 5-year window that we're looking at there. So whichever way makes the most sense, we're going to put the monthly distribution either in your bank account or back into the fund to reinvest and help grow the asset for you. So that is a little bit about Wesbow Capital. And so that is how we want to be your partner in whatever long-term goals you have for your investment portfolio. So we see ourselves as co-owners and partners in this appreciating pooled asset of residential rentals. We see ourselves as, in the aspect of stewardship, as stewards of your investment monies, and to take that very seriously, to put all the due diligence in order to see that they're used very strategically, and that we're positioned in that win-win for increasing growth over time. And that all of it really ties into what is the legacy that we are seeking to impact, be it individually for a personal legacy of supplying and providing for your family's legacy, so that there's complete financial freedom for the future. That's a legacy worth pursuing. Or there may be bigger philanthropic goals that you may have, and this is part of your overall strategy. Wesbow as well is participating that in developing world and building schools. And so thank you, Jay, for the opportunity, and everyone here. It's a pleasure to be part of this.
Thank you, Brian. I appreciate it. Great presentation. I'll now turn over the presentation to Matt Barnes, Director of Sales at Centurion Asset Management. Matt, over to you.
Hi, thank you very much, Jay. Great to be here today and good to see you.
See you too.
I'll just bring up my presentation here. Just give me 1 second.
No worries.
And I think we're getting some of your warm prairie weather out here today. So
yeah.
Hope everyone can see my screen.
Yeah, that works.
Perfect. Give you a quick update and outlook on the Centurion Apartment REIT. And really quick, I'll start with the firm itself. You'll see our founder's bio on the next page, but just you can see the firm was launched in August of 2009. Tough to see from this bar chart that it was with about 55 million in assets under management. Since then, we've grown to 6.2 billion and 320 employees. I think Greg Roman, our founder, I saw an early picture, it was him and a couple employees, and that was it. And we've seen some tremendous growth. I joined back in June of 2014, when we were about 600 million in assets under management. So we've seen some very good growth, but I'll say some very good growth done the right way. Very disciplined. You know, we've had no hesitation of passing on deals. We don't get in bidding wars for acquisitions. It is a very disciplined acquisition strategy, a very disciplined approach to how we manage the buildings and how we run the firm overall. I think here you can see the performance since inception. And just touching on it again, 2009 was a 4-month return. Our target return overall, though, is 7 to 12%. So that is income plus appreciation. And you can see since inception, we've done a very good job of that. And there's a few years there, 2017 through to 2019, where we did above that. We had very strong years. Can't say we're going to get those type of returns again. Nothing is guaranteed, obviously, but those were years when we're seeing similar characteristics now. People were, priced out of home ownership. Demand was excelling or exceeding rather supply, and we're coming into a similar situation right now. Previous presentation mentioned the increase in population growth. I'll touch on these powerful fundamentals, but that is definitely one. That is one that's going to be a real driver of demand for housing, obviously. But quickly, just going to touch on 2020. I think that would be the year I'd say we're most proud of on handling COVID, working with our tenants, keeping our buildings safe, all the best health practices, keeping everyone, as healthy as we could, safe and sound in the buildings, and then at the same time be able to provide, I think, a very solid return for investors in a year of extreme uncertainty. And then you can see, obviously, how we've increased returns since then as we get to definitely a more normalized environment. But the driving forces of real estate, really it is 3 things here. I want to just focus on the top 3 there. One, it is the unaffordability of housing. And I'm here in Toronto. I'm living downtown. I'm living in a downtown condo. And I see the prices. I'm very happy about mine 12 years ago, but I'm seeing the prices of newer ones that came out, 6, 7, 8 months ago. The prices were still, people were still taking advantage of the low interest rates before things really got, I guess, carried away a little bit. And the pricing, so with the healthy pullback in condos, with the healthy pullback in I'll say single family homes, we're still seeing in the GTA especially extremely, I would say, housing that really benefited from excessive demand and cheap financing. So even if housing does pull back, things aren't more affordable. Cost of a mortgage now has gone up dramatically, highest probably we've seen in a generation. And on top of that, we're also seeing strong immigration kind of year after year, we're going to have close to 500,000 people coming into Canada. Now we're a big country, we need that immigration coming in, but that simply pushes up the cost of housing. One, or the third point there rather, is because our supply doesn't keep pace. We don't build fast enough. And it's hard for us to see how we get ahead of that. The demand is going to be continually getting stronger and stronger, and it's going to be tough for supply to come close to matching that. And this is just gives you a few more metrics, a few more points on the population growth that we're seeing in Canada. And the middle point there, or I think the middle box, is very telling. You can see the targets for the next 3 years, and you can see the previous targets. Every year, we're going to have a record amount of immigration coming into Canada. And that's on top of obviously what we're seeing from international students, where you have great universities, relatively quite affordable versus our friends to the south. So a lot of the students come here, get a great education, and about 60% of them do want to stay in Canada. So obviously that's another bit of a demand for the housing sector that we're seeing there. But again, it's going to be continuous. It'll be kind of year after year. We'll see these very strong immigration population growth numbers. And again, it's just hard to see how our housing comes close to keeping up with that. And that is obviously a big factor. People want somewhere to live. And this is very telling on this slide here. Okay, the top point is touch on that is, and this was a point from about 2021, but still the data is still very, very relevant. From 2021, they're on track to build 18.5 overall. We're going to have in total 18.5 million dwellings in Canada. Single family homes, condos, apartment buildings, everything in between. But we need to build another 3.5 million on top of that between 2021 and 2030 to make housing more affordable. It's going to be tough to do that. I think that's a very nice way to say it. We're not going to get to that target. It's extremely tough. And I'll say this, even if we removed all the red tape, said, you know what, buy the land, you can start building tomorrow. You just don't have the skilled labor. Skilled labor is very much needed to, put up these large scale projects, to go into these 40, 50-story high rises. Obviously, never mind the skilled labor that goes into single family homes. Like, we just don't have enough to actually get out there and get ahead of this problem that is really we're seeing on the supply side. And again, with demand continuing to come in year after year. And I'll just touch on the bottom point there as well. Metro Vancouver's population is going to grow 44,000 between 2023 and 2026. And we're only going to see 1,500 purpose-built apartments per year being built. I think that's a little bit low. We're not going to get enough apartment buildings in the Vancouver area to help balance out that market. And I'll give you a good overview of where we're located. And this is how I'll break down our portfolio. One is 148 buildings, 144 are in Canada, so we'll just focus on Canada. But if you look at Canada, we're in BC and in Ontario. So in those two provinces, we're in the primary and secondary cities. And that's very purposeful. We're not going to be downtown Toronto. We're not going to be downtown Vancouver. We want to be where it's affordable, where it's attractive for people to live, but it's going to be out in the suburbs of those cities. And I know Kelowna is not a suburb of Vancouver, but that's a city we have some great assets in, very strong demand. They're a beautiful part of the country. And we actually have some great buildings on the island, Vancouver Island as well. But if you look where we are in Ontario, it is really the suburbs, exurbs of Toronto. Again, not downtown, we're out, say, in a Scarborough and a Etobicoke, then further afield, both east and west of the city. But again, we're positioned so people can live near the city at far more affordable rates than you would see if you're living in the downtown core. The rest of the country, we're only in the primary cities. So Alberta, only in Edmonton and Calgary. Obviously in Saskatchewan, just Regina. Manitoba, just Winnipeg. Even in Quebec, the largest rental market in Canada, just Montreal and just Quebec City. So I think we're extremely well positioned for where the demand is going to be. We're, again, in the areas where I want to say a lot of immigrants come to Canada, they come to larger population centers, but they don't want to pay downtown prices, or they can't in a lot of cases, pay the high cost of living in the downtown core. So they are more in the suburban areas because that's where the opportunities are in the larger population centers here in Canada. So we're extremely excited about how the portfolio is positioned and the demand we're going to be seeing coming into Canada over the next, I'll say, 5 to 7 years. Kind of look out to the end of the decade. We're extremely positive on what we're going to see in Canada. The population is going to grow. The country is going to grow, and we're very happy to be part of that, providing very high quality housing. At the same time, providing some attractive returns for investors as well. I'll just touch on two other things here. One is the lime green. We have 15 student housing buildings. They're doing exceptionally well for us. There's 1 year we were down about 82% occupancy. Prior to that, we were about 99% occupancy. We're now back to 99% occupancy. COVID obviously took a hit on our student housing, but great little diversifier in the portfolio. Medical offices, nice little opportunistic play there. We need more in Canada. I'll speak from Ontario's perspective. We do need more of everything on the medical health on medical side. So nice little acquisition for us there. And here's just a great example of one of the buildings we've recently acquired. And again, this is up in Kelowna. Love the Kelowna area. One being a very beautiful part of the province, beautiful part of the country. But these are the type of buildings we like. They're new builds, very attractive to a very large swath of the potential tenants in there. Really middle income type of properties with the amenities that they're looking for. But again, it's in Kelowna, a little bit on the outskirts of Kelowna, and very attractive pricing. So again, these are the type of buildings we love in the portfolio, and very excited to have those in there. You know what, with that, I'll leave it there. And if there's any questions, time for questions at all, or?
No, well, we're taking questions after the fact and we'll send them your way if we get them. Thank you, Matt. That was a great presentation. We'll be now going on to our next presenter, Darren Christie, President and General Manager at Skyward. Darren, over to you.
Thanks, Jay. Let me just see if I can get this up here. Does that look okay?
That looks great.
Excellent, everybody. Well, thank you very much, Jay, for the introduction. Skyward Equity Partners, by business owners, for business owners. I'm the CEO and founder. We're a brand new fund on Raintree's shelf. I'm going to give you just a very quick history of myself. I've got over 30 years of operational experience, completed over 10 successful acquisitions in my career. I was one of the co-founding partners of Planet Organic Health Corp, operating as Planet Organic Markets throughout Canada and the US. Grew that from one location, doing $1.5 million in revenue, to over 120 million in about 10 years, with 6 million of EBITDA. And we were one of the top 50 companies on the TSX Venture Exchange for a period of time. So let's get on to what Skyward is all about and kind of give you a bit of an introduction. We are a private equity firm located in Canada, focused on acquiring industrial businesses in the Canadian market. Industrial business such as metal machining and fabrication, industrial services, niche manufacturing, etc., in diverse sectors: pulp and paper, oil and gas, food and beverage, construction, and manufacturing. The size of businesses that we're looking for are businesses that generate between 500,000 to 5 million in EBITDA, operated by management that have significant stable cash flow and history of operations. And really what we're finding as a business owner in the market today, I can tell you there are a lot of owners that are approaching retirement without a clear plan for succession and selling their business. And we see that this opportunity is presenting itself now to make some very strong acquisitions at very, very favorable acquisition pricing. So let's understand a little bit about the strategy of what Skyward is all about. Basically, we're looking for sub-institutional companies at lower middle market valuations. So once we make this acquisition, we identify and implement improvements to these individual assets once acquired by Skyward. We realize the synergies amongst these companies in our portfolio and look for strategies and integration opportunities within the portfolio of companies that we have. And then we strategically manage the portfolio to fully crystallize the benefits to provide our investors with an exit strategy. So again, I really want to emphasize that what we are looking for is businesses that we're able to buy, because we're under the radar for a lot of other larger private equity firms, so we can get them at much lower valuations. And once we get our consolidated EBITDA to around 15 to 20 million, we will look at selling the entire portfolio. So let me talk briefly about two acquisitions we have pending right now. And I'm excited to say that the first one, Project Shelter, located right here in Alberta, is an Alberta-based company that manufactures and erects metal buildings primarily for industrial applications, but it also services construction, communications, oil and gas, agriculture, and more. We were able to get this business under asset value, and based on management's sales and EBITDA projections, under 2 times EBITDA. And we're tracking at about 80 to 90% of achieving those results in the first year. What's even more exciting is that we've raised the capital necessary to close this transaction, and we anticipate closing this by the end of this month. So again, we have the cash to close on this, and we are closing this deal at the end of February. The second company that we have is called Project Precision, which we have under LOI right now. This company is located in the Okanagan Valley in British Columbia. It's a metal machining, fabrication, and field fabrication company, very similar to my company called GT Metal Products. They've got excellent relationships with clients in their portfolio. And what's more exciting is it diversifies us outside of the oil and gas space. Only 10% of their revenue right now is coming from within Alberta, 30% from the lower mainland, and 60% from the Okanagan Valley. One of their main specialties is servicing many of the 400 wineries that are in that area in the food and beverage space. And based on management expectations, we're paying under 3.5 times EBITDA for this business. That's the value that we're generating with our fund. Now, if I look at the acquisition summary of these first two transactions that we have, on a consolidated basis, we're paying less than three times EBITDA based on management case next 12 months EBITDA projections. That's anticipated 5-year IRR range of 25 to 32%. And right now, my company, GT Metal Products, will come in immediately after these. I've already worked with the group at Raintree on valuation, so we're well within our valuation thesis of 4.25 times on average for our transactions. There's some very significant potential for operational synergies between these two businesses and GT, and these two businesses and themselves. On this slide here, I take a very quick look at our pending acquisitions and what our sensitivity analysis and our return that we're providing for our investors. Based on the fact that we're paying such great multiples, we're using an exit multiple of 5.5 times, which we feel is very conservative for a company that, or a consolidated group of businesses that are generating around 15 to 20 million of EBITDA. And based on management case or base case, you can see down in the bottom right corner that we generate returns for our investors between 25 to 30%. And even if we use a slightly lower multiple, our returns are still in excess of 20%. I want to explain something very important here. It's not because we're buying high-risk businesses, it's because we're buying good businesses at exceptional valuations. And what we're finding in the market right now is because we're under the radar for a lot of other larger private equity firms, we're able to buy these businesses without competing with several purchasers at the table, and therefore stay within our thesis of acquiring business at 4.25 times or less. So let's look forward a little bit. What's the exit strategy for our investors? Well, there's three. One of them, we sell the entire portfolio of companies that are doing 15 to 20 million on a consolidated basis. The other one is selling individual parts. Many of these businesses we're buying are going to be very similar to each other in the type of business that they do. And there's an opportunity to either consolidate some of those and sell them as individuals, or again, sell them as a whole fund. And the third option is a potential recapitalization. The one that we haven't talked about in here is the potential to go public, but it's not on our radar yet, but that is a fourth option for us as well. So what's the current offering for our investors? We're a growth income based. We're targeting a 5% annual cash distribution payable semi-annually to our investors with a target growth return of 21 to 25%. Again, driven not by risk, but by value purchasing. We're raising up to $3 million. Again, we've raised enough to close our first transaction, which will close by the end of February. And our time horizon is 5 years with 2 potential 12-month extensions. We have a very short time horizon. We need to execute quickly. And we're very excited because the amount of potential businesses there are out there that we are going to be able to achieve this. We have a 2% management fee. And our first financing, we are offering an 85-15 split, which is a little bit more favorable for our investors on the first financing. We have an 8% hurdle, and the minimum subscription is $25,000. Again, it's a very exciting offering for us. I'm the CEO and founder of Skyward Equity, and we're very excited about our future.
Thank you, Darren. That was a great presentation. Appreciate it, and keeping us back on time. So I really do appreciate that.
Yeah, thanks, Jay.
Thank you. I'd finally like to introduce our keynote speaker, Larry Berman, co-founder and chief executive officer and portfolio manager at Q Wealth. Larry is a multi-award-winning portfolio manager focusing on asset allocation and capital preservation with a value or GARP tilt to his investment style. His award-winning investment philosophy focuses on assessing risk and return. He's famous for saying, "You want me to put the odds in your favor when I'm investing your life savings." Larry is working on incorporating artificial intelligence into his investment process, as he believes it will remove behavioral biases that are inherently the most significant cost of emotional investing decisions. We will have time for a Q&A at the end, so please do send your questions. With that, I will turn it over to Larry. Thank you very much for joining us.
Oh, thanks very much for the invitation, Jay. Relationship with Raintree goes back about 5 or 6 years now. And, you know, in that time period, a lot's happened in the world. So a little bit of my presentation today is historical, a little bit is educational, as always, that I try to touch on, you know, on BNN. and a little bit funny, and a little bit sad. So hopefully we'll touch on everyone's emotions here, because the world we live in today is pretty complicated. And while I do have a crystal ball, as you can see here, or will you be able to see as soon as I start sharing my screen. So let me figure out how to do that and see. You see my
You're
screen?
good, Larry. We can see your crystal
We're
ball.
good. You see me? Perfect. Okay, there we are. So also below the crystal ball here, I want to talk a little bit about inflation. This is a $5 million or 5 million dinar, Yugoslavian dinar note. As all will know, Yugoslavia broke apart about 30 years ago. I was actually in my first international travel that I was a junior analyst at Burns Fry. I was in London, and we were sitting at the hotel, and actually at the table next to us was the Yugoslavian delegate that was going to speak to what was, a very political event at the time. And it was quite a remarkable memory for me. I'm not saying we're going into a hyperinflation period, but a 5 million dinar bill back in the early 1990s was worth about 35 cents US. The inflation rate back then in Yugoslavia was 2%. So that's the central bank target. That was actually 2% per hour. So it was quite an interesting period where you lose confidence in governments and their ability to control money supply. And there's a little bit of that today. There's not a lot of it. The world's a pretty big place here. But, crystal balls and trying to forecast what markets are going to do. I mean, at the end of the day, there's different ways of extracting alpha from markets. And one of the first ways that I learned how to do it was through my association with the Market Technicians group in New York. And very early in my career, I was at Burns Fry at the time in the early 1990s. I joined the Canadian Society of Technical Analysts and then the US Market Technicians. One of the guys that I had been familiar with because I was in love with Louis Rukeyser's Wall Street Week. Marty Zweig was an elf on Wall Street Week, and some of the other friends that I've now called friends were also elves on Wall Street Week, and I met them all through my networking with the Market Technicians. So Marty Zweig wrote a book. It was one of the first books I ever read, and it really got me thinking about the behavioral aspect of markets and decision making. And Marty had these investing rules. And the first one was the trend is your friend and don't fight the tape. So, be a trend follower. And that's kind of interesting because my style over the years has more been about mean reversion than trend following. Another thing that Marty said was don't fight the Fed, meaning the central bank controls the liquidity and be on the right side of that. And that's an interesting thing to dive into today, which we will a little bit. Not fighting the Fed. I think when you look at how bonds and stocks are priced today, one of them is wrong. One of them is fighting the Fed here. It looks like equities, but it's less valid than, what the trend says, because as we know, markets are very forward-looking. Number 17, beware of new era thinking. You hear a lot of commentary, this time is different. And I think this time is a little different than other cycles we've seen over the last 40 years because of inflation. And so while I'm not trying to fight it, I'm trying to recognize that maybe there's some different things at play here. And number 7 to me, and every indicator eventually bites the dust or fails. So nothing works all the time. And while we look into our crystal ball to try to figure out what markets are going to do, going back to 2016 and the beginning of Brexit, there was one thing that was pretty obvious to me, and that was, as interest rates came down, the fixed income component of portfolios weren't going to work anymore. I'll talk a little bit more about that, but looking for the perfect indicator, and perhaps Gisele Bündchen is the perfect indicator in many ways. All will know Gisele as the former wife of Tom Brady. I remember sitting on my chair and I saw this headline hit that Gisele wanted to be paid in euros and that the US dollar was no longer important. And I've highlighted when that news headline came out here on the red vertical. And, basically the supermodel, the rounding error, top ticked the euro. And I always find these kind of anecdotal indicators kind of interesting. But as it turns out, that's not the only thing she top tick. And recently, having made a big investment in crypto and FTX, and it looks like her and Tom may have top ticked crypto last year anyways. So having a little bit of fun with that. But the whole idea of looking at alternatives, things in your portfolio that have different types of outcomes, is kind of where the future is going here, because the traditional 60-40 portfolio is broken. When you look at some of the smartest investors in the world, and I would call Canada Pension Plan and sovereign wealth funds, and I had the very good fortune at one of my previous jobs before starting ETF Capital and what now has become Q Wealth Partners, is as a 10-year period where I was a strategist at CIBC World Markets. And part of my job was going around the world talking to portfolio managers, and in the case of Europe, sovereign wealth funds, and et cetera, and getting to see, what these people were doing with portfolios. And they approached markets very, very differently than a financial advisor would. And the use of more well-defined outcomes are far more important than the level of risk, the 60-40 kind of nature of portfolios. And I'll dig into this a little bit more here, but Ontario Teachers Pension Plan, who I would consider very, very smart money, actually one of the guys I worked with at Burns Fry in the early 1990s, just retired as head of Ontario Teachers, a guy named Ron Mock. And Ron ran the futures group at Burns Fry that I was doing some research for, back in the day. And, they got involved. They actually gave $75 million to FTX. And so when you're looking into these, private investments, non-tradable, the fraud happens. And you would think an organization like Ontario Teachers would have the manpower and team to do the due diligence, and they didn't. And then you look at the Bernie Madoff story, and you look at, the OSC having missed the fraud in bridging financing. There was a big fraud, and so where people want to commit fraud, it's much harder to get away. But the more you get away from public markets, the more some of these other kind of risks present themselves. And I'm going to talk to you a little bit about today about, the future of retirement portfolios and the fact that the traditional type of thinking, 60-40, may not be where we want to be. So around Brexit, this started a little bit before that. All will know that oil prices started to collapse in 2015 around the world. That put some stress on financial markets. We were getting into 2016, and by this time, Donald Trump was a candidate to be president. And the Brexit, like the betting polls said, no, there's no way Brexit will happen. It'll be close. And I actually believed it would. But when I started looking at the charts, what we're looking at here is the low point in interest rates up until, of course, COVID. And so you get these shocks. But prior to that, the yield to worst. So if you look at the graphic here today, YTW, that is like yield to maturity, yield to worst. It factors in optionality and some of the callables. But effectively, yield to worst is what you earn when you buy a bond. And at the time, the global bond portfolio, investment grade, was close to 1%. And I made the comment publicly on BNN and elsewhere in writing in the Globe and Mail that the traditional 60-40 portfolio wasn't likely going to work for the next decade, at least for the average investor. And I got called out on this by many, many people, but it's pure, simple math. And so you had a long period of negative real yields in fixed income, and it was pretty difficult to create a portfolio that would give clients, the end client, to, in 2011, the first baby boomers started hitting 65. In 2021, the median baby boomer is 65, and my God, before I know it, I'm going to be 65. And you think about then not working and funding the rest of your life with your savings. And, this to me is a big, big problem that we all have in the investment industry. And we have to really start thinking outside the box, because if we are going into a period of higher than expected inflation, the bond category is not only was it broken before, but it's increasingly broken at this point as a way to protect client portfolios. The next graph I'm looking at here, and this one is basically saying how much negative interest rate debt there is in the world. And so it was basically non-existent. And this is Brexit here in 2015, 2016, this shoot up here. And, we got to the point where I think somewhere in 2016 or 17, CIBC issued a 5-year note in Europe with a negative interest rate. And I just started, scratching my head and just saying, it makes no sense. And then, of course, we got into the stress of COVID and more Fed balance sheet expansion and all the other central banks in the world. And you got to the point where about 20% of all government debt in the world was trading at a negative yield, largely Japan and Europe. Never really happened in North America. But, again, it was a mathematical certainty that over the last 2 years, post-COVID lows and interest rates, that 60-40 portfolio wasn't going to work. And there had to be another way. But going back to Brexit, and so I've dated it back to June 24th, 2016 here. And what we're looking at is an index I created that consists of this Bloomberg Barclays Global Aggregate Bond Index. And we're looking at two of them here. One's hedged to US dollars and one is floating rate currency. And then VT, which is the Vanguard Total World ETF. It's basically every stock in the world. And so my comment 10 years later, not quite 10 years in this case yet, but we're getting there, that the 60-40 portfolio would be pretty useless, really rings home. So, the average return since 2016 of the 60-40 portfolio was 6%. Inflation over that period averaged probably 2.5 to 3. So you did get a real return, but where did it come from? It came from equities, right? It all came from equities, because whether you were hedged or unhedged in your global bond exposure, you had a slightly negative or slightly positive return. And that was always going to be the case. just given where interest rates were. And again, now is inflation going to be stickier, or is it going to take off on us? What do the central banks have to do? There's a pretty big debate going on right now on Wall Street, with all this. And the answer is, when we look into our crystal ball, is we don't know. Now we can go through to a very excellent resource, and I've put a link here. Research Affiliates every week or so updates this. Maybe it's monthly. Updates their forward-based estimated returns, real returns. So they're estimating what inflation would be, and they're looking at this. And so when we looked at this 2 years ago, that local 60-40, local meaning US dollar 60-40 portfolio was negative. And it's proven out that way for sure. Can you imagine if the central banks didn't do what they did to boost liquidity, coming out of COVID? But right now, for the next 10 years on average, they're forecasting slightly less than a 2% real return, so after inflation. And so that would be, if inflation's running at 3 in your financial planning, that would be a nominal return of 5. And so how many clients will get by with a safe withdrawal rate with a nominal return of 5? And when you start doing all those analytics, you realize that 50, 60, 70% of people out there are going to have a lower standard of living in their retirement years. And to me, that's a big social issue that people aren't really addressing. I mean, the people that have money and they'll just be fine in most scenarios, but the ones that don't are really going to struggle. And I fear that we've got decades in front of us of really bad demographics. I saw one study that said China's today at 1.4 billion people will have somewhere between 600 and 900 million people. So they're going to dramatically shrink the size of their economy over the next 30, 40 years because of their one-child policy. And so the terrible demographics in so many places in the world, where a country like India, where the average age of the population is 21, and it has very, very good demographics ahead of it. So you kind of wonder where the ball's going, where the puck's going in hockey terminology. So emerging markets actually stand out here as the best type of return, but also coming with, and small caps too, international markets, EFI, you can see there, but with significantly more volatility than 60-40. So how are we then able to deliver equity potential without having to put so much money in fixed income that it's actually going to hamstring us in our balance for delivering balance for clients? Because when you do that KYC and the client tells you, I want all the upside and none of the downside, how do you build that portfolio for them? Well, you got to bring in alternatives, and there's a lot of different types of alternatives we can bring in. But going back to the smart money, CPPIB publishes and has been for forever an annual report. I don't know how many of you look at it, but you should be. And when you think about building your portfolios for your clients, and you look at where Canada Pension Plan was in 1999, the US Treasury Social Security Trust Fund today is still 100% government IOU promise to pay. And that's effectively 1999 what Canada Pension Plan was. It was just all government bonds. And theoretically, the US could create another 3 trillion in bonds. The Fed can monetize that, and ultimately they could put that in the Social Security Trust Fund, and it would be completely funded. But that's all that exists today in the US. In Canada, they got it. They caught on that interest rates were falling, and they needed to go to other real assets in order to generate portfolios that had outcomes that were going to meet their actuarial liabilities. the actuarial liability when someone hits 65 that's going to on average live to their mid 80s is around 7.5% based on what they've put in over the last 40 working years, 45 working years. And so the mathematics don't work anymore. You can't create a 60-40 portfolio of traditional assets, and you certainly can't have 100% government bonds and remotely expect to fund that safely and adequately. And so, the entire U.S. Social Security Trust Fund is underwater. Yeah, I think everybody knows that quietly. It's the unspoken secret, but politically you can't do anything about it because you can't touch entitlements. And anyways, as of last year's report, real assets, so infrastructure and things like that, cash flowing, traditional fixed income, very, very small part of the portfolio. Where equities and far more global is really, where it's at today. I grabbed quickly to update this, what the composition is as of March 31st, 2022. And so you can see real estate, cash flowing infrastructure. Public equities in the Canada Pension Plan is 27%. Fixed income, government debt is 7%. So if your portfolios today don't look like this, then you're going to have difficulty meeting that hurdle for clients, I believe. If you've got too much in Canada, if you're overweight Canada, 16% here. There's a reason for that. That's largely the infrastructure, real estate, and for the most part, the fixed income part of the portfolio that's making up that 16% here in Canada. But international exposure, Asia Pacific, Latin America, emerging markets, you can see how overweight the Canada Pension Plan is internationally because the value is there. They don't care about the standard deviation as much, but if they did, they can manage it within the pool of assets by overlaying hedges and risk management using options and futures and swaps and all kinds of other things that an institutional manager can bring versus the traditional pension fund versus the traditional mutual fund that does not actually incorporate derivatives into their strategies. So when you look at a very, very simplistic example of the last couple of years, you've got the global 60-40 return over the last 2 years, and you could see that that's down about 8% total return. These are total return charts. If you made that portfolio up of these ETFs that Innovator ETFs came out with a few years ago that have hedges in them to buffer and volatility in the portfolios, and they have exposure. In this one, I'm looking at just the US market, but they have emerging markets, international markets, ETFs as well. And then you paired that with a private credit strategy, your 60-40 mix, had you done that, is up 10%. And that's very different than being down 8 in the traditional way of thinking. So, I think going forward, it's really, really important to think outside the box and in a non-traditional fashion in terms of what you put in your client's portfolio to deliver them that actuarial liability that we have to them. Once upon a time, you could just slot in 60-40, 70-30, 50-50, and it would be adequate. It would be more than adequate for the average person. And I think we have to think differently, going forward. So a little bit about the fund that Raintree uses, that's part of what I manage. I'm going to talk a little bit about that and how we go about doing what we do and how we were able to deliver pretty impressive returns over the last few years in very, very difficult equity markets in general. So everybody's familiar with the business cycle. There's different parts of the economy that do well, based on whether we're in a contraction, expansion, whether inflation is heating up or cooling down, etc. And we can go back and study the ups and downs of the economy and learn from that. And so investment factoring and looking at which sectors and which styles of investment do well in different parts of the cycle are really, really important. It's core to our security selection, and it's core to our ETF tactical selection, that we emphasize certain parts in the portfolio. It's not good enough to just say, hey, I like energy because that guy's a good manager. Because there's going to be parts in the cycle, times in the cycle where energy is just going to be a terrible part in your portfolio. And outside of the last year and a half or so, that's been the case. And so I'm not trying to poke fun at my Alberta friends, but energy isn't always good to have in your portfolio. It has been recently. When I on BNN came out a few months ago and said, hey, it's time to short traditional energy and overweight clean energy, I get hate mail from people in Alberta because they don't want to hear it. But the facts are the facts. I don't care. And it's kind of like what Maynard Keynes said and others. You know, when the facts change based on the facts and the probabilities, you got to change your mind. You can't always be dug in. And if you are going to be dug into something, it's going to work against you in the long run. Going back to what we learned from Marty Zweig and those very, very exceptional rules of Wall Street that he came out with in the 70s and 80s and finally published for everyone to see. And I was very fortunate to have those connections very early in my career. When you look at research affiliates, again, this is from one of their white papers. When we look at the different types of companies that do better, it's not surprising that high profitability companies do better in recessions. DUHP is a DFA-based ETF that uses the profitability factor as a weighting to pick the companies. It's not surprising that we're doing a really, really good in that ETF compared to the broad market. And so emphasizing certain factors at certain points in the business cycle add a lot of value. And so every quarter after earnings, we kind of look at the forward-based, what Goldman Sachs is saying and everyone else and what consensus is, and we put our own spin on that. We say, okay, what does the next year look like? Recession, slowdown, recovery, growth, what part of the business cycle are we going into? And then we rebalance our portfolios based on what investment factors are likely going to perform. And so from the very early days, going back to 2016, in 2016, we ran separately managed ETF portfolios for clients. And recognizing the interest rate problem and doing that, we needed alternatives. The only way to effectively do alternatives in the investment counsel space was to launch pooled funds. And in 2017, we launched pooled funds and incorporated derivatives and hedging strategies into our portfolios. And then, of course, we got to zero interest rates again, and we were wondering, well, the fixed income side isn't going to do it. So how can we deliver lower volatility to clients and still give them that balance they need from a risk perspective? And that's where we incorporated a lot of volatility hedging strategies by way of put options and structures in our portfolio. So this is the last couple of years return of the series of the fund that is incorporated in some of your strategies that we manage. You can see 2021 was a pretty big up year, and we did really well in 2021 with our upside capture. But 2022, where the broad growth aggregate index, was down, was at 17-18% last year, and we had a positive return on the year. That's pretty something. And when you look at the benchmark, so the volatility of the benchmark since we made this structural shift in our portfolios, away from using more balanced and fixed income to using derivatives to hedge, the benchmark 60-40, or sorry, in this case, we use an 80-20 because we're a little more growth oriented in this portfolio, had a standard deviation of 18. We were able to deliver that portfolio at 16.6 with an average annual return annualized of 11.2 versus negative for the benchmark with a very, very exceptional Sharpe ratio of 0.61. So that's kind of a bit of the evolution of my thinking here. I do think when it comes to prediction, because every time you do a keynote, you got to do a bit of a forward-based prediction. And going back to my crystal ball, I look at this index, and this is the OFR Financial Stress Index. It's a multi-factor model that looks at credit and bank lending and the volatility, the S&P 500, junk bonds, you name it, they factor this in. And so you look at where this financial stress index is, and so when the index is above 0, the financial stress is higher. When the index is below 0, financial stress is suppressed. You can see during the dot-com bubble how financial stress indicators were elevated above 0. Obviously, the great financial crisis, the Greek debt crisis, or the Southern European debt crisis, if you will, in 2010 and 2011. The bond market, the problem with high yield and specifically crude oil markets collapsing in 2014, 2015 with the fracking revolution, changing the supply and demand and impacting, and you guys remember the pressure on Canadian Select at that point. Obviously, the 2020 COVID, and then of course you got the I guess the rate hikes that the Fed was starting to put in the rate hikes. We had the volatility spike, if you will, in early 2018. That actually didn't cause any stress in financial conditions. We did finally see financial condition stress elevated in the latter half of 2018, and that's where the Fed pivoted again. You remember the Powell pivot in early 2019 and to where it is today. So you look at financial conditions, because the Fed talks about this a lot. Financial conditions today are easier than they were before the Fed started raising interest rates. And if the Fed's goal here is to tighten financial conditions to curtail inflation, higher for longer, to me, is going to win over the Fed's going to pivot and switch and ease. So you look at what the front end of the curve is doing, pricing in an easing cycle, and a lot of that after last, or 2 weeks ago, payroll number came out a week and a half ago. A lot of that has come out. Interest rates in the long end have backed up a little bit, but equity markets, relatively speaking, are still holding their bid. And it's this whole idea of this pivot coming and this soft landing. And I'm just not sure the Fed is going to be able to allow that to happen if they want to really get inflation back to that 2%, not 2% a day like in Yugoslavia, but that 2% target. So it's going to be a challenging year ahead of us, or 2 or 3 or 4 or 5. If you're only thinking traditional, I did catch some of the last 2 speakers, and Centurion is a good manager of REITs, and I didn't know that other manager you had there, but I think a lot of those alternatives are important to have in portfolios. The problem with a lot of them is that there are liquidity constraints, and so you got to know your client and know your product as to whether that stuff's appropriate. But definitely you got to start thinking different. I think inflation is going to be a little stickier than my friend David Rosenberg believes, for example. But that's kind of the world I see.
Sorry, folks, I think we've lost our speaker. We've lost our internet connection with our speaker, I think, who froze off. Hopefully everyone can hear me still, I'm hoping. We don't have any questions from the panel. Somebody please let me know they can still hear me so that I know that everyone's still on the line. Okay, perfect. Everyone can still hear me. So I want to thank Larry for his comments. I'm sorry that we probably lost his internet connection. He was calling in from the States. So I do appreciate his thoughts as well as his sharing of information regarding the markets, as well as his performance has been quite well over the last year, has added a lot of values for clients who we manage for at Raintree Wealth Management. With that, I guess there's no questions specifically. So I just want to thank, first of all the speakers today who provided great insights into their investment solutions. I think, it was a wonderful conference and a lot of information was passed along. I want to personally extend my sincerest gratitude to all the investors for attending the virtual conference. We hope that you found this conference beneficial and informative in helping you gain valuable information on various topics such as diversification strategies, risk management, and portfolio optimization, as Larry talked about. Going forward, if you have any questions that weren't answered today, I do ask you that you reach out to your Raintree Private Wealth advisor for any follow-up questions, and they can direct them to us. If not, you're more than welcome to direct questions directly to any of the Raintree team members themselves. With that, this formally concludes our conference. Thank you very much for all attending. Enjoy the rest of your day. Thank you.